Welcome, SIE candidate. I'm Brandon from Basic Wisdom, and this is a completely free video-based practice exam that was built to look and feel as close to the real exam as possible. I will put each question on the screen for 3 seconds, allowing you to pause the video and to take a stab at the question yourself. And when you're ready for the answer and my explanation, hit play. I recommend you keep track of your score along the way. If you end up passing this exam, which would be a score of 70% or higher, you're probably ready for the test. The higher that score, the better. If you don't pass the exam, it's not the end of the world. Continue grinding, continue learning, and use it as motivation to continue pushing yourself forward. I would be so grateful if you liked the video, subscribe to the channel, especially because I'll be releasing more videos like this on a weekly basis moving forward. If you're having any trouble with a securities licensing exam, hit me up. You can text me at 720-593-1865 anytime. But with that being said, let's dive in. All of these entities are regulatory bodies in some way, shape, or form, but there's one part of this question that highlights the answer. It's really at the end of the question. Which of the following organizations does not have the authority to enforce its own rules? There are 3 organizations up here that have enforcement power and one that does not. The one that doesn't is the MSRB. The MSRB is a self-regulatory organization, basically a non-government entity that's been given some power to regulate the industry. In particular, the MSRB regulates the municipal securities market and its participants. It writes rules, but it doesn't have any enforcement power. Now, if we're looking at the securities markets, FINRA and the SEC enforces rules for the MSRB. And with the Federal Reserve, that Federal Reserve actually enforces MSRB rules for banking institutions. But bottom line, the MSRB is just an organization that writes rules. They have no enforcement power. Therefore, C is the right answer. The only time a representative can take any action on behalf of a client without having their explicit approval to take that action is if they have something that we call discretionary authority. That's also sometimes referred to as trading authorization. Now, this question doesn't specifically mention either one of those. And I know you might be thinking, hey, well, what if there is trading authorization in place? And this is actually a good test taking skill for any of these securities exams. You live within the world that they built for you. If they don't mention trading authorization or discretionary authority in some way, shape, or form, just assume it's not there. And one of the pillars of discretion, basically, when a representative is taking action on behalf of a customer, is the quantity of the trade. Like, how much do you want to buy or sell? And we just don't get that from this customer. The call was poor. The connection was poor. We don't know how much they want to buy or sell or transact. Therefore, anytime we're taking that extra step and actually guessing as to what the client wants to do here or what's suitable for the client, the only time we can do that is when we have discretionary authority or trading authorization on hand, which we clearly do not have in this question. Therefore, the best answer is going to be answer choice C. This question is referencing a risk that we refer to as interest rate risk. Interest rate risk is the risk that interest rates go up, which forces the market values of pretty much all fixed income securities downward. And so right away, we know because interest rates are going up, we know debt prices are declining. Every answer here is some type of a debt security. So the question is, which one of these is going to move the most in price? Which one has the largest percent change in their market price downward? And there's one rule of thumb you have to live by for this. It's long and low. The debt security with the longest maturity and the lowest coupon will move the most in price when interest rates fluctuate. And there's one clear answer here. That would be answer choice B. Not only is it the longest maturity, but is the lowest coupon. An MFP is a representative specifically in the municipal securities market that does anything with municipal securities other than just retail sales. Now, sometimes you might get a question on what an MFP is, and there's what you need to know to get to the answer. They tell us in this question that we have an MFP. And the typical angle on this exam is to talk to you about political contributions in relation to MFPs. In particular, what we worry about is what we call a pay for play scheme, meaning if I'm going to contribute to some political candidate's campaign in hopes that hey, they see my contribution and they see that I'm giving them money, and when they hopefully win that candidate seat, that they will then send business to my firm afterwards. We're trying to avoid a situation or a world where we're built around giving money to campaigns and hopefully we get business out of that. That's not a good world to live in politically or even in the securities industry. Therefore, the rule that they're referencing here, which is Rule G37, by the way, you don't need to memorize this rule number. You don't need to know it's specifically Rule G37. They'll tell you and give enough context in any question to know what they're talking about. But the rule on political contributions for MFPs is if they give above $250 for any local campaign or any money to a non-local campaign, basically a campaign that they can't vote for because they're not a resident in that municipality, then they trigger what we call a 2-year ban on doing business with that firm and that representative. So if we give above those amounts, then the firm and the representative can't do any business with that municipality for at least 2 years. Now, the problem is we look at the answers and every single one of them is above the $250 mark. So what's going on here? The key here, and it's kind of tricky because you have to understand how our political system works to get this answer right. This rule only applies to municipal campaigns. Now, what's a municipal campaign? Think about any political campaign at the state level or below. So you're looking for state campaigns, city campaigns, and local campaigns. Something like the governor would be a state campaign. A city campaign would be something like the mayor. A local campaign would be like a council person representing you. Now, if you look at the answers, 3 of these are just not going to be considered municipal campaigns. Answer choice A, U.S. Senate, even though your senator does represent you from your state, that's not a municipal campaign. That's a federal role. Same thing with the president. The president is not a municipal campaign. That's pretty clear. That's a federal position. Answer choice C is referring to making a contribution to a political party, like if you make a contribution to the DNC or the GOP, but that is not a municipal campaign. The only one up here that is a municipal campaign is answer choice D. That is running for city mayor. This is a campaign to run basically your city. So this is above the $250 mark. It is also a municipal candidacy we're looking at. Answer choice D is correct. The magic age with retirement plans is 59 and a half. Basically, if you take money out of a retirement plan before the age of 59 and a half, you're probably going to face a 10% early withdrawal penalty, plus whatever taxation you would typically already pay when you take money out of that type of retirement plan. Now, this person's age 52. They specifically say it's the money's taken out for non-qualified personal expenses. It is important to know that there are some exceptions to the early withdrawal penalty. For example, you could take money out for a first-time home purchase and avoid the early withdrawal penalty. You can take money out for disability purposes or even death, meaning if someone dies that holds an IRA and you inherit that account below the age of 59 and a half, can you take money out of that account and not pay penalties? Yeah, you can. In fact, you're typically required to. But looking at this question here, we have a person age 52 below 59 and a half. There's no reason or no exception that they have to avoid the early withdrawal penalty. So they're going to pay that 10% early withdrawal penalty. And then on top of that, a traditional IRA is typically contains deductible or what you might refer to as pre-tax money in it. So regardless of whatever age you take money out of a traditional IRA, you're going to pay taxes on those distributions already. So answer choice B is going to be the best answer because it reflects that reality. This question is referring to something that we call Regulation T settlement. Now, if you looked at Regulation T and just immediately thought 50%, which is the margin rule when you're making initial purchases, that is a thing, but there is another element of Regulation T, and it specifically focuses on what is the last day you could legally pay for a security and not, let's say, get in trouble. I mean, no one's going to jail or, getting fined or anything for this. But if you buy a security, let's say on Monday, you have to pay for that trade by one of you can refer to this as one of two ways, either T+3 or S+2. Now, keep in mind what I'm referring to here. Regulation T settlement is different than regular way settlement. If you buy a security on Monday, it will settle regular way the next business day on Tuesday. Now, regular way settlement is just a reflection of when are you officially anointed as the owner of the security, assuming you're buying it. That would be the next business day. But Regulation T settlement is focused on what is the last day you could pay for the trade and still be okay. That would be the third business day after the trade date or the second business day after the settlement date. That's basically the same day. Either way, if we make a trade for a security, if we buy a security on Monday, Thursday of that week, which would be the third business day after the trade date or the second business day after the regular way settlement date, Thursday would be the last business day we could pay for the trade. Now, if that trade is not paid for on that day, there's two things that could potentially happen. Number one, your firm technically could reach out to the appropriate SRO, probably FINRA, and ask for an extension on the trade, an extension on the investor paying for the purchase, which, by the way, your firm will typically never do that. The second and more common thing that happens is that the firm, if you still hold the position, is just going to sell you out of the position. You didn't pay for it. It's not yours. So we're going to sell you out to pay ourselves. The broker dealer will sell you out to pay themselves the cost of the trade. And then on top of that, they're going to slap your account with what we call a free riding, or sometimes we refer to it as a good faith violation. Free riding violation, it results in the account being frozen for 90 days. Now, it doesn't exactly sound like what it means. A frozen account just means that you have to have the money in the account next time you purchase something. The money has to be in the account before you make the trade. But bottom line, the best answer here is answer choice B. Mutual funds transact on what we call a forward pricing basis. It sounds weird, but when you buy or sell a mutual fund, you're never really sure exactly what price per share you're going to get. If you place a trade, say on Tuesday morning, like this question says, you would place a trade typically to say, hey, I want to either sell all my shares, I want to buy $15,000 of this mutual fund, whatever. But you place the trade, and then later that day, after the market closes, usually about an hour or two after the market closes, the fund's net asset value is released and reported publicly. That would be basically what you're buying or selling the mutual fund on a per share basis. Again, you don't know what that is before you place the trade. You basically saying, hey, I just want to sell all these shares at whatever the next available price is. So for this question, place a trade on Tuesday morning, they're going to get that day's closing price, which won't be known until after the close of the market Tuesday afternoon. Therefore, answer choice B is the best answer. The public offering price is something that the investor would obtain if they're buying a front-end loaded fund. That's something that we only see on the buy side, not when they're selling. Now, when we say that the investor's liquidating, that means they're selling all their shares. But the other problem with answer choice A is they're referring to previous day's close. No, when you place a mutual fund transaction, you're always getting the next closing price. If you're placing it during market hours on a business day, okay, you'll get the closing price later that day. If you place it, say, Friday afternoon after the market is closed or over the weekend, you'll get the next business day's closing price, typically Monday's closing price. There is no exchange trading of mutual funds. Mutual funds are redeemable securities. You always buy and sell them directly with the issuer, and there is no specific bid-ask spread that we even care about with this. The next calculated net asset value is what the investors are going to get here. Options are tricky. And if you struggle with options, shameless plug, but I do have an options course for the SIE. Go to basicwisdom.net to go check that out. But the best way to approach this question, first and foremost, is I would eliminate two of the wrong answers pretty quickly. We have all four option versions up here, option types. There are two that are bullish and two that are bearish. Now, we have an investor who's bearish, so they're expecting the market price to go down. So let's get rid of the bullish options. Long calls, or when you're buying a call, that is bullish. And when you're selling a put, that is also bullish. So it's not going to be answer choice A or B. Answer choices C and D are both bearish options that make money if the market price goes down. But which one's the better answer between the two? It's going to be your long put, answer choice C. The reason being, if the investor is expecting a significant price drop, long puts make more money the further the market price goes down. Also, long puts come with limited risk. The most you can lose is the premium. If you're wrong, you're not going to be, can't lose everything or lose an unlimited amount of money. On the other hand, a short call comes with limited gain potential. The most you can make would be the premium. So the further the market price goes down, it really doesn't matter. You just make the premium. And then on the other hand, you are subject to unlimited risk. The higher the market price goes, so if you're wrong, market price goes up, you're losing an unlimited amount of money. For those reasons, answer choice C is the best answer. The Federal Reserve is our central bank that covers and institutes and enforces monetary policy. Monetary policy is basically the money policy. How much money is in our system at any given point in time? And it might not seem like a crazy thing, but the Federal Reserve is incredibly powerful. They have the power to create US dollars out of thin air, and they have the power to destroy US dollars. And those actions have big impacts on what's going on with the economy. Now, all four answers are things that the Federal Reserve has in their wheelhouse. These are things that they can do. But during an economic contraction, meaning things are going bad in the economy, the economy is shrinking, the Federal Reserve wants to do everything it can to bring interest rates down, to bring the cost of money, of borrowing money down. Why? If it's cheaper for people, businesses, and organizations to borrow money, that will stimulate the economy. More of those entities will borrow money, spend that money, and bring the economy back. So we're looking for the answer that's going to result in lowering interest rates. Now, if we think about the money supply, the way you bring interest rates down is you expand or loosen the money supply. When there's more money to lend out, banks charge less when they lend out that money. It sounds weird, but you almost want to treat money like any commodity. The more there is of it, the cheaper it should be to borrow it, and vice versa. The less there is of it, the more expensive it should be to borrow it. So, looking at the answers here, answer choice A, increase the reserve requirement. What that does is it makes banks hold more cash on hand. When you deposit money at a bank, if the bank has a reserve requirement, that means they must keep some of the money you deposit at the bank in their vaults, and they lend out the rest to us other customers. That's how banks work. When a bank has to keep more in their possession, that means they can lend out less. That shrinks or tightens the money supply. And if that means there's less money in the system that bring interest rates up, that is not what we want to have happen. So it's not going to be answer choice A. Answer choice B and D, we're going to skip those for now. Right now, let's go to C. Increase the discount rate. Now, the discount rate is the only rate that the Fed has direct control over. It is the rate at which the Fed lends to banks. If a bank needs to borrow money, the first thing it's usually going to do is go to other banks and try to find that money. Other banks typically lend at what we call the federal funds rate. But if banks have nowhere to borrow money from, they can always go to the Federal Reserve. The Federal Reserve is sometimes referred to as the lender of last resort. And the rate at which the Federal Reserve lends to banks is what we call the discount rate. Now, if they increase their own interest rate, the Fed saying, hey, if you want to borrow money from us banks, we're going to charge you more. When the Fed increases their own interest rate, guess what? Interest rates across the board also increase. That is not what we want to have happen. So answer choice C is not going to be the right answer. Something I want to point out is a test taking skill here with answer choice B and D. This will not always work because sometimes FINRA will just give you nonsense answers. But if you're clueless on a question and you have two answers that are exact opposites of each other, that's usually an indication that one of those has to be the right answer. And sure enough, that is going to be the case here. B and D are referring to what we call open market operations. These are situations where the Federal Reserve is trading securities, typically treasury securities, with banking institutions. And if you think about it, if the Fed is buying treasuries from banks, so the Federal Reserve goes to, say, Bank of America and says, hey, we want to buy $50 million of treasury bonds from your portfolio. When the Federal Reserve buys something, they're creating money out of thin air. That's loosening the money supply, making it bigger. And I would encourage you, when you think about open market operations, follow the money. If banks are getting the money, they have more money to lend out. They will bring interest rates down because they have more money to lend out and they can charge lower rates and still make good money. And if the Federal Reserve is buying treasuries, treasuries are coming from the banks, cash is going to, the treasuries are going to the Federal Reserve, is going to the banks. Banks have more to lend out. That loosens the money supply. Answer choice D is going to be our right answer here. It's the only one that is a loosening tactic that the Federal Reserve has. If we go real quick to B, selling treasuries, that would mean the treasuries, the Federal Reserve is sending treasuries to the banks, and the banks are paying money for those treasuries. So money's coming out of the banking system. Banks have less money to lend out. Therefore, interest rates typically go up in that environment. Bottom line, answer choice D is our correct answer. There are a couple ways you can answer a question like this. Some people use the bond triangle. Now, I don't typically use it, so if you're a fan of that, go for it. If it works, awesome. I really like the bond seesaw. And this is what it looks like at the right-hand side of your screen. We have the nominal rate, also known as the coupon in the middle, then current yield, yield to maturity, yield to call. We have prices on the left-hand side, yields and interest rates on the right-hand side. And when I get a question like this, here's all I'm doing is drawing out the bond seesaw. And then they tell us that we're buying a bond at a discount. So it's kind of like the seesaw looks like this. And you have to imagine the yields on the right-hand side are kind of going up on that side. But bottom line, all we need to know is what happens to the yield to maturity when a bond is bought at a discount. Now, the nominal rate or the coupon is exactly in the middle. And if you think about being in the middle of a seesaw, you don't go anywhere. When either side's going up or down, you're still in the middle. So when we buy a bond at a discount, the yield to maturity goes up, the nominal rate stays the same. So the yield to maturity will be greater than the coupon rate. That's just kind of the caveman bond seesaw way to answer the question. Answer choice A is the correct answer. But if we're thinking about it more conceptually, yield in particular, at least when we compare it back to coupon, yield is a reflection of an investor's overall rate of return on a debt security or an income-based security. The coupon just tells you how much you're getting paid annually in terms of interest off of a debt security. For example, if I have a 5% coupon bond, but the yield is 7%, I have a bond that's basically paying me $50 a year, but it feels like I'm getting paid $70 a year. The yield is higher. The only way you can get there is if you're buying the bond at a discounted price from the par value. Basically, for example, let's say you're buying a bond at $900 and it's going to mature at $1,000. That extra $100 is extra money in your pocket. And that's the only way that you can make more money on the bond or a bigger return on the bond than what the coupon tells you. So bottom line, if you're buying a bond at a discount, your yields will always be higher than the coupon and vice versa. If you buy a bond at a premium, the yields will always be lower than the coupon because a premium reflects the fact that you're buying the bond at a higher price than what it's going to mature at, kind of like losing money on the purchase price of the bond. Bottom line, answer choice A is their correct answer. This is a private securities transaction. Basically, anytime a representative is doing or facilitating a securities transaction outside of the company or the firm they work for, again, that's a private securities transaction. The thing that the representative wants to avoid doing is something that we call selling away. Now, selling away is whenever you're doing a private securities transaction and you don't follow the rules that we care about and that are enforced by FINRA on this type of transaction. You can do these if certain rules and protocols are followed. Now, first and foremost, you always have to notify your firm in writing that you're going to do the private securities transaction. That always has to be done. Therefore, that automatically gets rid of answer choice B and answer choice D. Those are just nonsense. Now, the next thing is a maybe. You also have to get written approval from your firm to do it, but only if you're getting paid. And this representative is clearly getting paid for this private securities transaction. Therefore, answer choice A is our best answer. If they were doing it pro bono or if they're doing it for free, technically answer choice C would be the best answer, but they're getting paid. Got to give written notice to your firm. Hey, I'm doing this. And then you have to get written approval from your firm to get paid. Most securities licenses that you obtain when you pass exams last 2 years. If I pass the Series 7 or the Series 65 exam and I don't get registered and don't do anything beyond that, that registration, that license will last for 2 years. But there's one big exception. That would be the SIE exam. The SIE exam lasts for 4 years, an additional 2 years on top of what a normal license would last. So answer choice C is the correct answer here. One thing I'll call out though is FINRA does have what we call a maintaining qualifications program, what we call the MQP, that allows representatives to keep their registrations and their license. SIPC insurance protects investors against broker-dealer failure. And what we mean by that is if I have all my assets held, say, at ABC broker-dealer, or basically a company like a Robinhood, a Fidelity, a Schwab, one of those, if I have my account there and then that company goes out of business, let's say I go to their website and I try to log in and that website is offline because the company's now out of business, SIPC would come in and make sure that I get at least some of my money and my securities back. And it does not protect against bad market decisions. So if you invest into a stock that ends up losing, SIPC is not going to help you there. Again, it's for broker dealer failure. And the insurance is up to $500,000 per registration, inclusive of $250,000 of cash. So when we look at this question here, this investor has $600,000 in a margin account invested in securities. That's above that $500,000 limit, but they also have a debit balance. And for margin accounts, we factor the debit balance out and we only look at the net equity in the account, which is $400,000. $400,000 is below the $500,000 threshold. Therefore, answer choice B is the correct answer. When we see language like privilege to purchase, that might sound kind of like the right to purchase something. This is in reference to what we call a derivative security. Now, probably the most common place we're going to see this on the exam is going to be with a long call, a type of option, which is the right to buy stock at the strike price. But obviously, we don't see options up here, so it's not going to be the answer. And this is describing a security that gives existing common shareholders the right to buy new stock in a short-term basis below the current market price. What this question is describing here is a rights offering, a preemptive rights offering to be specific. Basically, what happens here is we have an issuer that's going to be issuing more stock to investors. Maybe they're doing an additional public offering, sometimes years after their initial public offering. And if these issuers have what we call an anti-dilutive covenant, or if they have an anti-dilution measure within their corporate charter, they might have to give their current shareholders the first right to buy that stock from them. And it might even be advantageous for them to do this. If they can get their current shareholders to buy the new stock they want to sell to investors, the issuer doesn't have to hire an underwriter and pay an underwriter for their services, which that's kind of why they sell these or offer these and give the investors the right to buy new stock below the current market price. They're saying, hey, if you buy it from us, we don't have to pay an underwriter, so we'll pass the savings to you. We just want to raise money and do something with this new raised money. Those are preemptive rights. Now, some of you may have gone with answer choice A. Warrants are really similar to rights. It is the privilege to buy stock, but warrants are typically issued with no intrinsic value, meaning that the right to buy stock is currently you can buy stock at a price above what they're currently worth when they're initially issued. And also it has nothing to do with existing common shareholders. Warrants are typically issued as what we call a sweetener alongside another security. So for example, you buy a bond and that bond comes with a warrant. That warrant gives you, say, the right to buy the company stock at 60 when it's currently worth 50. So it just doesn't make sense to use the warrant now. Also, warrants are longer term. Warrants oftentimes can last 5 to 10 years until they expire. And what you're hoping is if I have the right to buy the stock at 60, well, right now the stock's at 50. Well, what happens if in 10 years, right at the expiration date, the stock price is at 90? Well, now my right to buy at 60 is more valuable. That's a warrant. Obviously, this question is not describing that. The answer is B. This is a preemptive right. This question is kind of similar to the one that we saw before about discounts and prices of bonds and yields. You have to know that fixed income securities like bonds and preferred stock have an inverse relationship with interest rate movements. If interest rates go up, their prices go down. If interest rates go down, their prices go up. And it has to do with dynamics in the market. In this question here, we have an investor that has a 5% corporate bond. And whenever we look at a 5% coupon or a coupon of a bond that's in existence, usually the coupon is reflective of what was going on in the interest rate environment when that bond was initially issued. Or just plainly stated, when this investor bought this 5% corporate bond, interest rates were probably around 5%. 2 years later, similar bonds are being issued with 3% coupons. All we need to take from the first two sentences would be that the investor buys a bond and then interest rates go down. That's it. They bought a bond, then interest rates go down. If interest rates go down, the price of the bond goes up. They now have a higher yielding bond in a lower interest rate environment. If you have a 5% bond and brand new bonds today are being issued with 3% coupons, you have a valuable thing, you have a valuable asset, and you can sell that at a premium price. Therefore, we can automatically get rid of answer choices A and D. We know the price is going up. Now, what happens to the yield? Yields and interest rates go in the same direction. You can kind of think of it that way. So if interest rates are going down, yields are going down too. But probably the better way to think about it is if a bond is getting more and more expensive, then the rate of return on that bond or the yield on that bond, basically what you'd make on that bond if you bought it at its current market price, the more expensive something is, the lower your rate of return on that thing. Therefore, answer choice B is our best answer. As the bond's price goes up, the rate of return on that bond goes down. You could also get there just by remembering there's an inverse relationship between prices and yields. When price goes up, yield goes down, and vice versa. There's no instance where the bond's price would go up and the yield would also go up as well. That wouldn't make sense. It's getting more expensive, and because it's getting more expensive, you're making more money. No, that's just not how these work. When an investor establishes a new position in a margin account, the standard way we look at it in terms of how much money they have to deposit, this would be Regulation T, would be that they have to pay for half of the purchase. And that would be in particular for any time we have a total purchase amount really of 4,000 or more. So if you're buying $10,000 of stock, you deposit 5,000. If you're buying $50,000 of stock, you are depositing 25,000. Same thing if you're selling short. It's generally speaking the same rule. The problem here is that we're buying a smaller amount. If we do the math here, this is $1,500 of stock. There's a secondary FINRA rule, which is mentioned here, FINRA Rule 4210. There's a secondary FINRA rule that says in order to use margin, you have to have at least $2,000 of equity in the account. And when we look at this question here, that directly reflects the answer. Answer choice C is our best answer here. Now, some of you might have thought that the answer was B. If the investor bought stock in their account, let's say they bought 100 shares and went long 100 shares at 15, that's $1,500 of stock. When you buy stock, the worst case scenario is you lose the entire value of that investment. So if you're buying less than, say, $2,000 of stock in your margin account, you're just pay for the whole thing. You don't have to deposit more than the full purchase amount. The reason why the investor is depositing more than the total value of the position here is because short stock positions have unlimited risk potential. This investor, yeah, is selling short $1,500 of stock, but they can lose way more than $1,500. And that would happen if the market price of the security starts going up, 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 up. So bottom line, if you're selling short stock, it doesn't matter really what you're doing or what it looks like. At minimum, you have to deposit $2,000 into your margin account to establish that position. We have another MFP question. This MFP is contributing to a municipal campaign. They are well above the $250 limit that they are subjected to. So therefore, that's going to kick off a 2-year ban that would apply not only to the member firm, but also the representative too. Meaning if the representative quit this firm and joined another, that new firm they join onto would also be subject to the 2-year ban. Therefore, answer choice A is our best answer. FINRA has rules that revolve around gifts. Now, gifting could be to a client, it could be to another representative in the industry. But the gift limit rule, which has recently been updated, is now $300 per person per year. If you give a gift to, say, a client like we're looking at here, and that gift is worth more than 300 bucks, you're usually in some form of trouble or you're breaking the FINRA rule. Now, there are two big exceptions to this rule. I'll start with the less common exception that the exam might cover, but there is an exception for what we call gifts related to big life events. So big life events would include things like weddings, birth of a child, funerals. So if my client's family member dies, could I send them a $700 bouquet and be okay? Yeah, I'm probably fine there. The other exception, which the test oftentimes does cover, is what we call business entertainment. Now, the difference between a gift and business entertainment is business entertainment always involves some type of event, number one, but number two, the representative is there alongside the person they're giving the gift to. So in this example here, they're going to a charity tournament. It's a $1,200 entry fee. That is well above the $300 limit. But the reason why this is okay is because the representative is there alongside the client. Now, if they paid for their tournament fee but didn't show up to the tournament and the client went by themselves, that would be a problem. That would be a violation. So this is permissible. Technically, they don't even need authorization from their security principal to do this. Now, their firm might have a policy in place that says, hey, if you're doing something like this, you need to get approval first. But FINRA just says if it's business entertainment, you're good. It just can't be excessive or crazy. What would be excessive? I buy my client a $25,000 Super Bowl ticket and I go to the Super Bowl with them. You'd probably get in some trouble there. But the bottom line here is that we can go above the $300 limit as long as it's considered business entertainment. When is it business entertainment? Is if the representative is there alongside the client at the event and it's not explicitly excessive. Answer choice B is our best answer. Another options question. Again, if you need help on this, I got an options course. Go to my website and check it out. But the underlying formula for this question is what's on your screen. The premium of an option is equal to the intrinsic value of the option plus the time value of the option. And if you know that, and then you know how to figure out intrinsic value, you can get to this answer. There's no way to calculate time value as a separate thing. Basically, we're going to turn this into like an algebra question. We already know the premium. The premium is $7, right? So the question is, what's the intrinsic value? Well, with put options, whether you're long or short, there's a phrase that you should always use. That's call up, put down. Now, this is a put again, so put down. If the market price is below the strike price is 55 and the market price is 50, how much it's below the strike price will tell you how much intrinsic value is. The market price of the stock is $5 below the strike price. So this option has $5 of intrinsic value. And like I said, this basically turns into an algebra question. $7 is equal to $5 plus X. Time value must be $2. Answer choice A is going to be our best answer. Real estate investment trusts are basically a fund of real estate or things that are tied to real estate. If you imagine kind of the idea of either a mutual fund or closed-end fund, but instead of there being stocks or bonds in there, it's a bunch of real estate stuff. That's the concept of a real estate investment trust. Now, the question's pretty vague. Hey, well, what's true about a REIT? So let's go through each answer. First and foremost, answer choice A is not true. Passing through income and losses is something that we see typically, and I meant to put an X there, that's an X. Passing through both gains and losses is something that we see on what we call direct participation programs. Something like a limited partnership is notorious for that. And what that means is that when the business either makes or loses money, they just flow that through to the owners of the business and it shows up on their tax returns. In those instances, those businesses are non-taxable entities. Everything just flows through to the business owners. REITs can pass through income. Basically, if a REIT makes money on its real estate investments, it oftentimes will pass through the money it's making to its shareholders so that the REIT doesn't pay taxes itself. In fact, that'll relate directly to answer choice B. But if the REIT loses money on a real estate investment, it has no ability to pass through that loss to its investors. Now, I know that sounds like a bad thing, passing through a loss. Like, who wants a loss? When we say passing through a loss, that means that you're getting a tax deduction in some way, shape, or form. So, actually, if you're looking for a tax write off, it's usually a pretty good thing to be passed through a loss. But bottom line, REITs cannot pass through losses. The big thing on this exam that can are direct participation programs, in particular, limited partnerships. Answer choice B is true. Subchapter M, which we sometimes refer to as the conduit rule, basically says if you're a fund or a REIT, if you make money for your shareholders and pass through at least 90% of that to your shareholders, then whatever you pass through to them is not taxable to the REIT or to the fund. And these funds are and REITs are greedy. They don't want to pay taxes when they don't have to. So they pass through oftentimes 98 to 99% of the net investment income they make during the year. Answer choice B is not only true for REITs, it's also true for mutual funds, closed-end funds, other investment companies as well. REITs also have some added things on top of the normal rule. There are some rules about how much the REIT must have invested in real estate, how much the REIT must derive from in terms of income from directly from things like real estate. Those are usually testable on the Series 7. I don't think you'll see those on this exam. Just be aware that subchapter M, the conduit rule, 90%. Be aware of that and you're okay. Answer choice C is wrong, not just because B is right, but there are two primary types of REITs. There are equity REITs, which invest directly into real estate. And if you think about like, how do you make money on real estate? You either buy that real estate at a low price and then sell it later at a high price. That's a capital gain. Or you can buy a property and rent it out to tenants. That's what equity REITs do. And that is what answer choice C is referring to. That's an equity REIT. A mortgage REIT is a REIT that either buys mortgages, typically on commercial properties, or even offers mortgages to typically corporations to buy commercial properties. It's kind of like a mortgage-backed security in a weird way where you're just making money or making interest income off of loaned money. Mortgage REITs do not invest directly into properties. They buy the mortgages directly tied to those private properties. There is one other REIT out there called a hybrid REIT, which is a combination of an equity and a mortgage REIT. But bottom line, answer choice C is directly describing an equity REIT, not a mortgage REIT. And then last thing, answer choice D, REITs are not open-end management companies. That would be a mutual fund. REITs, in fact, are not even any type of investment company. They are a trust, basically. So again, they're not qualified or regulated by the Investment Company Act of 1940 because they're not investment companies. That confirms it. Answer choice B is our best answer. Preferred stock is an investment that investors seek out specifically for dividend income. That is why you buy preferred stock. I want to buy this thing and typically get quarterly dividend payments off of this. And preferred stock doesn't technically even have a maturity date. So you could buy a preferred stock, it pays you dividends forever, technically. Just like common stock, preferred stocks don't come with any kind of legal obligation to the issuer to actually pay those dividends. Even though investors buy preferred stock for the dividends, issuers can just be like, hey, we're just not going to pay you dividends anymore because we're in financial trouble or just because we don't want to. And there's no legal recourse an investor has if that happens. If a preferred stock does start skipping dividends, an important thing to be mindful of is whether or not that stock is cumulative or non-cumulative. And the only difference between the two is whether or not the issuer is obligating themselves to make up those dividends at some point in the future. Cumulative preferred stock means the issuer has to make up those dividends at some point in the future, especially if their plan is to make a common stock dividend payment. They can't make any common stock payments until they're up to speed with their preferred stockholders and have made them whole. If it's cumulative, they have to go back and make up those dividends again. If it's non-cumulative, then they don't have to make up those payments that they skip. Obviously, from an investor standpoint, cumulative is a better feature to have, but also if we're looking at two different preferred stocks that are exactly the same, except one is cumulative and one is non-cumulative, the cumulative one would probably trade at a higher price and therefore would have a lower yield. You'd have a lower rate of return on a cumulative preferred stock. Now, with that being said, that has to be answer choice C. This is an American depository receipt. Let's just go ahead and get right to the answer. ADRs make it really easy for investors particular US investors, to buy and sell what feels like foreign stock. I'll give you an example. Like Honda Motor Corporation, which is a company based out of Japan, Japanese company, you can buy Honda HMC stock on the New York Stock Exchange. How is that possible? Well, a bank like JP Morgan Chase, a long time ago, went to Japan. They had their foreign branch in Japan buy up a bunch of foreign Honda stock. They put that stock into usually a trust. They then slice up that trust into units or receipts. Those receipts are then registered with the SEC and then offered to American investors just like any other stock. These buy and sell and trade in US dollars. When dividends are paid, you receive them in US dollars. There still is currency risk on these investments because, in particular, if there's a dividend payment that's made, when Honda makes a dividend payment to its shareholders, they make those dividend payments initially in Japanese yen. And the bank that created the ADR has to convert that yen to US dollars. And if there's a bad conversion rate, well, that's currency risk there. So even though everything's in US dollars, you still have to worry about ADRs having currency risk. Bottom line, this question accurately describes an ADR. We're looking for the security that's subject to federal taxes, but exempt from state and local. So let's go through each answer and talk about the tax status. Corporate bonds are fully taxable, federal, state, and local taxes. So definitely not going to be answer choice A. Now, Fannie Mae is a federal agency. Now, when we think about federal security, something like a treasury bond or a treasury bill, or even maybe a treasury note, those are taxable at the federal level, but exempt from state and local taxes. That is true for pretty much anything that comes from the federal government, except for mortgage-backed securities. And a pass-through certificate is a mortgage-backed security. Mortgage-backed securities are always fully taxable across the board. So answer choice B is not going to be the answer. I kind of gave away the answer there. Treasury notes, those are federal securities. Pretty much if it's from the federal government, it's not mortgage-backed, then it's going to be federally taxable, exempt from state and local taxes. In case you're wondering, like, I think there's an easy way to remember the government stuff. One level of government generally is not going to tax the other level of government stuff. The federal government will tax their own stuff, but the state and local government won't. And when we go to D, a municipal bond, which is state, city, or local government bond, municipal bonds are generally exempt from federal taxes. They might be subject to state or local taxes, in particular if you buy them outside the state they're issued from. So for example, if I live in Colorado and I buy a municipal bond from Texas, the state of Colorado is going to hit me with state income taxes on that bond. But bottom line, D would kind of be the opposite of what they're asking for here. That's not the answer. That confirms it. Answer choice C is our best answer. Focus on the name here of the joint account with rights of survivorship. A joint with rights of survivorship account is one that when a account owner dies, their surviving owner takes everything. It's completely their account, assuming there's just two people on the account. Now, technically, a joint account could have unlimited number of joint owners. Typically, we see two. If one of the owners passes away, then the account becomes property 100% of their surviving owner. Therefore, answer choice B is their correct answer. Now, a couple things to point out. Probate, which is typically a pain in the butt, probate court is used by Americans to figure out like where money goes when someone dies, in particular if there's no instructions. Now, a joint with rights of survivorship account, we know exactly whose money that is. If there's a surviving owner, it's their money. So there's no need for probate. If we had an individual account with no beneficiary designation, or in particular, if both people on the joint, on any joint account die, then you have to worry about probate. The other thing to bring up is the other big type of joint account being a tenants in common account. Tenants in common is an account where when one owner dies, their portion of the account, which is usually predetermined, their portion of the account goes to their estate, and anything that goes to your estate is subject to the probate process. But obviously, that's not what we're talking about here. Answer choice B is our best answer. This is market manipulation. Now, it's important, I think, for you to know what market manipulation is, because there are prohibited actions and then there's market manipulation, which is almost always straight up illegal. You can go to jail for this stuff. Market manipulation is anything you're doing to artificially influence the price of a security. And that could be, I'm doing something to move the price of the security up, the price of the security down, or even to keep it flat. And this certainly matches that. This is market manipulation. I'm going to skip to the answer here. Answer choice is B is going to be a right answer. We call this wash trading. We also might see this referred to as a matched orders. Sometimes I've seen this word come up more recently, spoofing. All of these are there are some different versions of these, and without going into the details, basically, if you're submitting a bunch of either fake trades to the market, or if you're trading with someone else, or and there's really no change in ownership, you're just trying to drive up trade volume or make it seem like there's more demand or more supply than there actually is. It's going to be some version of the three things I mentioned there. That's wash trading. We already talked about what free riding is earlier. Free riding is basically buying a security and then not paying for it. That comes with that 90-day restriction that we talked about. That's not market manipulation, that you won't get in really any trouble beyond your account just being restricted for 3 months. The other two up here are prohibited actions, not market manipulation, but prohibited actions. Interpositioning is when a firm includes an unnecessary middleman in a transaction, just basically to make more money off of a client. Can't do that. Trading ahead is anytime you have a firm that puts their own account and their own interests before their own client. Can't do that. Always got to put your client's interest first. Answer choice B is our best answer. Unregistered people, basically administrative assistants, or oftentimes people that get into the industry and start talking with customers of a firm before they're fully registered or before they pass their licensing exams. There are things that you can do even if you haven't passed your exams or haven't been registered, but you're limited. You can do what we call quotes and imbalances. In fact, when I first joined my first firm, I was on what we call the quotes and balances team. Client will call up and say, "Hey, what's Google stock trading at?" And I can give them the price. I could tell them balances in their account. I could send them account statements. I could invite them to events that the firm was putting on. In fact, that kind of hints at the right answer. Answer choice B is our best answer here. But what can't you do if you're in that position? You can't take any type of trade whatsoever. It doesn't matter if it's solicited or unsolicited. By the way, unsolicited means it's the client's idea, but it doesn't matter. You can't do any trade. You can't discuss any type of characteristics or aspects of securities. And, you generally want to avoid that stuff. So answer choice C is not going to be the right answer. And a big, big, big no-no is you cannot qualify your clients for suitability, meaning you can't talk through, hey, what's your investment objective? What's your risk tolerance? Well, let's talk about what might be good for your account. That is a big no-no. Cannot do that. But you can definitely invite prospective customers to join. Hey, my firm's putting on a seminar. Do you want to join? Totally fine. If you are challenged by order types, I've got 7 order type videos on my channel. Just search on YouTube for Basic Wisdom Order Types playlist. You'll find all of them. I've got videos on every single order type. And if you struggle with this stuff, watch those videos and you will be good to go for the exam. But one big thing I teach in those videos is this silly set of acronyms that is incredibly helpful for this concept here. So we have an investor that places an order to buy 100 shares of XYZ stock at 45 stop, 46 limit. This is a buy stop limit. Now, if you know these order types, buy stop is above the line, buy limit is below the line. Now, slobs for bliss indicate where the market price needs to go for something to happen. And I'm just going to walk you through exactly how I would approach this if I were in your seat. First thing, the reason why we call these things stop limits and not limit stops is because you want to approach a buy stop limit, or really any stop limit order, as a stop first, limit second. When we're looking at the stop price first, we're asking ourselves, at what point will this order trigger? Now, again, stop is the first thing we care about. So we're going to look at the buy stop component of this. Buy stop is above the line. The stop price is 45. So for this order to trigger or activate or elect, whatever term you want to use, we need to see the price of XYZ hit 45 or above. That's just for it to trigger. Okay. So if we look at the prices, the price subsequently rises to 45.10. That is 45 or above. Therefore, the order triggers at 45.10. And when it triggers, it's basically like the stop part of the order disappears. Now it's a buy limit at 46. So buy limit is below the line. In order for this order to now go through, we need the market price of the stock to go to 46 or just to be at 46 or below. So then I just, I know 45.10 was the trigger price. So now we're going over to the next price, 45.80. All we have to ask ourselves is that 46 or below? And it is. And because it's 46 or below, the order will execute at $45.80. Answer choice B is our best answer. We have a stock dividend question. Stock dividend is basically where an investor gets more shares of stock, which sounds cool. Awesome. We get more shares of stock, but the price per share of the stock will fall proportionally. So at the end of the day, it's just a wash. Stock dividends don't really help you out at all. Just we're moving numbers around. You have more shares that are cheaper now. For a question like this, the first thing I recommend you do is establish what the position is. 100 shares at 80, that's $8,000 of stock total. Now, regardless of whatever happens here, at the end of the day, once the adjustment is made, the investor is going to end up with $8,000 total dollars of stock. Just the numbers are going to look different. Now, you could technically get to the answer just knowing that. But I'm going to take it a step further in this question to show you the actual math. In case you get a question that makes you do the math. Possible, depending on the answers they'll give you. Here's what you do. I use this thing that I call the stock dividend factor. Try not to think too much about what's going on here, but start with the number 1, and then you add the stock dividend percent in decimal form to that number 1. So if it's a 20% stock dividend, our stock dividend factor is going to be 1.20. We'll say 1.2 to make it simple. So my factor is 1.2. Once you have that, all you need to do is take that factor, multiply it times the number of shares you start with, and then divide the price per share, wrong side, divide the price per share by that same amount. That will get you to the right answer immediately. And if you do the math there, the investor is going to end up with 120 shares at 66.66. We'll round up to 67. And if you do the math, 120 times 66.67, you're going to get something really close to $8,000, give or take a penny or two because of rounding. That's one way you can always double check your math. Answer choice C is our best answer. One other thing to point out here is stock dividends are not taxable until they're actually sold. So you can receive a stock dividend today. Like, I'm getting 20 extra shares here. Remember, nothing's really happening. It's just numbers are being moved around. That's why the IRS doesn't send you a tax bill immediately. Now, later when this investor goes and sells the shares, those shares are, that's when we would consider the stock dividend taxable. But the bottom line is you don't get a tax bill when you receive a stock dividend. You would get a tax bill if you received a cash dividend in the year you received it, but this is not a taxable event until the shares are actually sold. It still is. Answer choice C. Anytime we get a yield question, in particular, like stack ranking, which one's the highest or lowest, this is a bond seesaw question. If you can recreate this on the exam, you're good to go. This question tells us the investor buys the bond at a premium. So our bond seesaw looks like this. And just imagine the yields kind of falling down there. So which one is going to be the lowest? This one's real simple if you know your bond seesaw. Answer choice D is our answer. Let's go through each one of these subdivisions of the secondary market. I know it sounds weird, but the first market is part of the secondary market. But yeah, these are 4 divisions of our secondary market. So after a security has initially been issued by the issuer, depending on what that trade looks like, that puts us into one of these 4 subdivisions. Let's go through all 4. First, when we look at the first market, okay, the first market is when we have a listed stock trading on an exchange. So if I buy Coca-Cola stock and that trade happens on the New York Stock Exchange, that is a first market trade. That's simple. That is not obviously the answer. Answer choice B is an unlisted stock trading OTC. If a stock trade happens outside of an exchange, it's an OTC trade. If it's an unlisted stock, so meaning a stock that is not eligible for trading on the New York Stock Exchange or NASDAQ or something like that, usually you'll find less reputable companies, maybe companies, with financial troubles, or even maybe a newer startup company in the OTC markets only. That's a second market, I should say. The third market is where listed stock is trading OTC. If I want to buy Coca-Cola stock, yeah, Coca-Cola is primarily listed on the New York Stock Exchange. That's where a lot of its trades happen, but it can also happen in the OTC markets. There are market makers out there that buy and sell Coca-Cola stock with investors just like the New York Stock Exchange does. It is my broker-dealer's responsibility to send my trade to where there's best execution. That could very well be off the exchange. That's a third market trade. But none of these, the first three answers, none of these match what the question's asking here. Fourth market is institution to institution trading, typically off exchange. We'll say off exchange, maybe even see like ECNs here, or also DP for dark pools. Institutions, oftentimes, if they're doing a big trade, don't want to deal with the public markets. Just a lot of hassle. When you want to trade $100 million of a stock, let's say you want to buy it, that introduces a lot of demand to the public markets that the public markets may not have the ability to handle. So if we have like a big, like Fidelity institution that wants to do $100 million trade, it's probably better for them to go to another institution like Morgan Stanley and do that trade directly. And if they do that trade directly, oftentimes without the use of a broker or dealer involved, then that would be a fourth market trade. Oftentimes those are involved in what we call electronic communications networks, which are like big bulletin boards where institutions say like, hey, I want to buy $100 million of Meta stock. Anyone out there want to sell me it? This bottom line is going to be the fourth market. Anytime you get a question talking about institutions trading directly together where it's like off of like the public markets, it's almost always going to be the fourth market. All of these bonds up here are different types of municipal bonds, but there is only one that is backed by full faith, credit, and taxing power of the municipality, and that would be your standard general obligation bond, your arguably most popular municipal bond out there. The others are not backed by the general taxing power of the municipality. You might look at answer choice C and think, okay, why isn't that the answer? First and foremost, this is a revenue bond, and when you have a revenue bonds are backed by the facility or the thing that creates that revenue. And oftentimes special tax bonds are backed by what we call vice taxes, like taxes on cigarettes, gasoline, tobacco, things like that. And this is it's not something directly tied to a municipality's full faith and credit. Industrial development bonds are, bonds that are issued to, build usually like a corporate facility. Corporation moves in, pays a lease payment to the municipality, and those lease payments pay off the bond. That has nothing to do with what we're talking about here. And a moral obligation bond is not technically backed by anything of the municipality. It's kind of like a pinky promise. Hey, we're going to issue this bond. We're going to raise money from investors, but we're not going to legally obligate ourselves to pay that money back. That's what a moral obligation bond is. The only answer that makes any sense up here is answer choice B. What rights does a common stockholder have? Well, let's go through each answer and talk about if they have it and if they don't, like what's the situation. Common stockholders do have rights to assets upon liquidation of the company, but answer choice A is just completely false. Bondholders or creditors are above all stockholders. You basically go secured creditors or secured bondholders, unsecured bondholders, debenture holders, preferred stockholders, and then common stockholders. Common stockholders are at the bottom of the priority list, so answer choice A is not correct. Answer choice B is also not correct. Now, it sounds kind of like one of the rights a common stockholder has, which is the right to inspect books and records. All that means is that the issuing company has to give their shareholders some idea of how they're doing financially. And they typically accomplish that through SEC Form 10Q and SEC Form 10K. The 10Q is the quarterly financial disclosure. The 10K is the annual financial disclosure. But you're not going to have access to the company's employee payroll records. That's way too detailed and way too sensitive to give access to that. Shareholders do have the right to vote on major actions of the issuer. In particular, stock splits are a big thing that stockholders typically vote on, and board of directors. That's the other. In fact, that's arguably the biggest thing stockholders are going to vote on is who's going to serve on the board of directors. Answer choice C is going to be our right answer here. Answer choice D is also false. Stockholders have the right to receive a dividend, but you have no right to vote on a dividend. And that probably should make sense, right? Like, do common stockholders have the long-term interest of the company in mind if they're voting on dividends? Probably not, right? If you gave me the right to vote on a dividend as a shareholder in a stock, I'd be like, pay me $1,000 per share dividend today, right? It's probably not in the long-term interest of the company. So it's the board of directors that approves if a dividend is paid, not the shareholders, but shareholders do have the right to receive a dividend. Bottom line, answer choice C is our best answer. This is kind of similar to the question we saw earlier on discretionary authority or trading authorization. Another term that we see here that could be used in the same kind of way would be power of attorney. Now, power of attorney is just giving the ability to someone else to act on your behalf. The question, you got to be careful with reading these questions. It sounds like there's a discretionary trade recommendation in place from like an analyst within the firm, but it's clear that this account doesn't have any type of trading authorization, discretionary authority, or power of attorney. So because we don't have that on file, the representative cannot make any trades for the client unless they get their explicit approval to do so. And they did not do that. So this is straight up just a violation. Answer choice C is our best answer. The ACATS system is how customers can transfer assets from one firm to another really easily. I don't know if you've ever done this before, but it's incredibly simple as long as you fill out all the right paperwork and do all the things you're asked to do. The way this works is that, strangely enough, if I say I want to move my money from firm A to firm B, I would first go to the receiving firm, the firm where the money is going to. In fact, you don't even really need to talk to the firm where the money's coming from. I know that sounds mean. You can just say bye with you can ghost your former firm basically, but you go to the new firm where the money's going, the receiving firm. You fill out their ACATS paperwork. That firm B in this example, will send that transfer instruction form, TAF, to firm A. Now, firm A, when they get the form, they have 1 business day to look at the form and say, hey, okay, this is either in good order, we can definitely do this. Or if there's a problem, then they will nullify, or they will send back what they call a NIGO, not in good order, a NIGO thing. Sorry, I'm looking for the right terminology here. Basically, they would say firm A, hey, there's something wrong with this paperwork. Now, what could be wrong is either if the representative or the customer is asking for the wrong account, maybe they put the wrong account number on the form, or maybe they're asking for something that can't be transferred over, something like a proprietary product. So if it's a product that they can only hold at firm A and the customer is asking to transfer it to firm B, what firm A would say is, hey, basically your customer has to either liquidate this security, he has to sell it, or they have to keep it here. We can't transfer this over to firm B. Now, if none of those problems are in place, then the firm A has 1 business day to validate, and then they have 3 business days to transfer the assets to firm B. The big point here, answer choice A is our best answer. That's a time frame that we are subject to in the industry. Just do your continuing education. It's incredibly simple and should never be a problem for you to do this. Now, there's 2 different types of continuing education. There's firm element continuing education, which is your company, your firm's own version of CE, where they basically walk you through like, hey, here are the things we offer. Here are the things you need to keep it back in your mind. Let's keep you educated and make sure you don't break any kind of rules or policies. And then there's regulatory element continuing education, which is FINRA's version of CE. And oftentimes when I used to go through this, I used to remember just going through like, hey, here's how you recognize money laundering. Here's how you recognize if a customer is experiencing dementia, just things to keep on the top of your mind as you're working as a representative in the industry. Regardless of whatever type of CE it is, you have to do this on an annual basis. And if you don't do your CE, in particular, your regulatory element, your FINRA CE, if you don't do it, you get placed in an inactive status, meaning that until you do this CE, you can't really do any kind of job that's tied to your license. So you're put into an inactive status. You can do unregistered stuff for the firm. That's fine. You can, like the stuff we are talking about earlier in that previous question, but you cannot do the license required stuff until you finish that CE. Answer choice B is our right answer. This is kind of a tricky question because brother-in-laws are considered restricted persons technically. They fall into that bucket for Rule 5130. Now, what is Rule 5130? By the way, you don't have to memorize the rule number, just need to know this rule exists. It's a rule that states that if there's an initial public offering of a common stock or an equity investment, we do not allow restricted persons. The big restricted persons would be member firms and their employees. So like you, if you're working for your company that you're working for in the industry and you, um, we prevent those restricted persons from buying those primary market offerings. Why? It's because we want an initial public offering in particular to be available to the public. If it was bought up or eligible to be brought up by people in the industry, like would the public get access to it? Maybe not if it's a super popular IPO. So we just say, hey, if you're a restricted person, you can't buy into this. Restricted persons are, representatives in the industry, employees of member firms, basically, but it can extend out to their immediate family member. Immediate family members would include, I call it the rule of one up, your parents, one down, your kids, one over. It would include your siblings and or your partners. Also includes in-laws, like your brother-in-law. The brother-in-law kind of falls into this category of a restricted person. So that, you might think that I want to be mad at if any of you answered answer choice A here, but there is an exception for the immediate family members is number one, if that person does not derive material support from the representative and they're not doing the trade through the firm of the representative, then they can technically buy the IPO. So the best answer here is answer choice B. Now, if that brother-in-law was either financially dependent on the representative or they were trying to do the trade through the firm, to the firm where the representative or the individual works, those would be problems. They would not be able to take part in the IPO. Bottom line though, answer choice B is correct. Even though this question is on a variable annuity, I want to broaden this out and I want you to think about the answer, which would be the same of really for any retirement plan. So whether it's a variable annuity, which is a type of retirement plan, a traditional IRA, 401k, 403b, whatever. If you have money in the account and haven't taken that money out yet, there is no taxation. You are sheltered from taxes. That is one of the big benefits of retirement plans. Same thing with education plans like 529 accounts and covered Ls. When you have the money in the account, that money grows on typically what we refer to as a tax deferred basis. So the only time you worry about potentially paying taxes is later when you take the money out. But bottom line, as long as the money's in the account. In fact, with a variable annuity, when we say the accumulation phase, we're saying the phase where you're putting money in and allowing the account to grow and accumulate. Bottom line, these are tax deferred until you take money out later. Answer choice C is our best answer. There are two different big types of underwritings. There are firm underwritings and best efforts underwritings. We'll start with firm underwritings. Now, maybe even take a step back from that. When we say an underwriting, we're saying an issuer wants to sell a security, wants to raise money from investors, wants to sell, let's say, a stock. Issuers oftentimes need help from an underwriter to do that. Underwriters are companies like Morgan Stanley, Goldman Sachs. These are companies that help issuers find investors to buy up their securities that they're offering in what we call the primary market. There are two different ways this can look. In a firm underwriting, the underwriter would buy up all of the security directly from the issuer, put it into their inventory, and then try to flip it and sell it to their own customers. For example, let's say the SpaceX offering. Morgan Stanley, if they buy up all SpaceX's stock, put it into their inventory, and then try to sell it to their customers at a profit, that would be a firm underwriting. And if for whatever reason there's a lack of demand, like they can't sell all the shares, whose problem is that? That would be the underwriter specifically. Now, if we're going further in detail here, like oftentimes with underwritings, there's what we call a syndicate. And within a syndicate, which is just a group of underwriters, it's typically the syndicate members that would maintain what we call that liability of unsold shares. So if this was a firm underwriting agreement, answer choice D would be the right answer, but it's not a firm underwriting. It's a best efforts. Best efforts is where the underwriter is trying to sell as many shares to investors as they can, but whatever shares go unsold, that goes back to the issuer. So is the issuing organization's problem for any unsold shares? The answer choice is C, is best reflective of what we see with the best efforts offering. Another options question, and again, if you need help, go to my options course, but this one's really simple if you know options. Whenever you buy an option or go long an option, doesn't matter if it's call or put, whenever you go long an option, worst case scenario is that you lose the premium. You're paying for a contract that'll give you a right to do something, right to buy if it's a call, right to sell if it's a put, but you're paying for a contract that gives you a right to do something. And worst case scenario, you don't use that right. You just let it expire. So worst case scenario is just the premium. Now, if you know options, premiums are stated on a per share covered basis. Every contract covers 100 shares. So a $4 premium really means 400 total dollars. Answer choice A is our best answer. It may not seem like it, but this is another slobs over bliss question. When a stock pays a cash dividend, you have to be mindful that the price of that stock will drop by the amount of that dividend on the ex-dividend date. So in this case here, we have a stock, let's say it's trading at, let's say $46 a share. If there's a 50-cent cash dividend paid on the ex-dividend date, the open of the ex-dividend date, that stock will drop at minimum by 50 cents. So the next day would open at 45.50, for example. The reason why the rule that relates to this question exists is, when you place an order below the market, that would be for your, let's point them out here, your buy limits or your sell stop orders. These are orders that you're placing where, hey, I want this to go through if the market starts falling. But do we really want these orders to go through just because a dividend was paid? Not necessarily. So if you place an order below the market, it would be a buy limit or a sell stop order, either one of those. And you do not put what we call a DNR, okay? A DNR, when you submit a order to your broker dealer system, it'll ask you if you want to place it as do not reduced if it's a buy limit or sell stop order. Do not reduce is exactly what it sounds like. It says, hey, even if there's a dividend payment, don't reduce the order. But unless that's there, and if we look at this question here, they don't mention anything about a DNR part of this order. We're just going to assume that if it's a buy limit or a sell stop order, that order is going to be reduced by the amount of the cash dividend. Now, this is a buy limit order. It is below the line. Therefore, this order is going to be adjusted downward from 45 down by the amount of the dividend to 44.50. It's adjusted downward. So with that being said, answer choice B is our best answer. We've got a longer story here, but we have an insider trade happening. Insider information, which is any material, non-public information. By the way, the word material just means it's information that someone would consider making a trade on. Like if I say that Nike is a corporation, that's not material information. But if I say, hey, Nike just created a shoe that makes people go like 3 miles an hour faster and no one knows about it, that's material information. I might buy Nike stock because of that. Sharing material non-public information is not illegal. In fact, if it was illegal, then how would any CEO or executive in a company talk about anything that the public doesn't know about? So sharing insider information, not illegal. Trading on insider information is illegal. And when there's a trade based upon inside information, you've got potentially a whole line of people that can get in trouble for that trade. The rules say that not only the tipper, the person who tipped off the other person, that told the other person the insider information, the tipper and the tippee, the person that received that information, then traded on that, could get in trouble and oftentimes will get in trouble. So bottom line, It's not just the person that gave the information or person that transferred the information. Whenever insider trade happens, you go all the way up the line to wherever the information originated from, and all those people get in trouble. And on top of that, maybe even your firm can get in trouble if they didn't have good policies and procedures in place to prevent insider trading from happening. Therefore, answer choice D is our best answer. This is a sneaky tough question. Felony convictions, and we'll call it securities related misdemeanor convictions, are what we consider statutory disqualifications. Now, whenever something material changes on a representative's U4, that has to be updated. The question is how quickly. And there's two different timeframes. For standard updates, it's 30 days. Now, what's a standard update? If let's say a representative gets married and changes their last name, they obviously, something on the U4 just become materially untrue. So therefore, we have to update the U4. That would be an example of a 30-day update. If it's an update that involves a statutory disqualification, that is a 10-day time frame. Now, you might think that because I'm saying that I'm pointing to answer choice D. It is not answer choice D. It is actually answer choice B. And the reason for that is this word. Being indicted on a felony is something that you do have to update your Form U4 for. If you look at Form U4, one of the things it'll say is if you've ever been charged with any felony or one of the misdemeanors that we care about, you gotta let us know. You gotta update your Form U4. This is a 30-day time frame. This is what we would consider a kind of a standard update. Now, if they had a felony conviction, that's where D would come into play. So this is a tough question here, but this is a subtle one. Bottom line, the indictment's going to probably create some problems for them. Doesn't mean they are automatically kicked out of the industry. Hey, they might be found not guilty, but the bottom line is if it's a charge or an indictment, felony, or one of the misdemeanors we care about, then it's a 30-day update. But if it becomes a conviction, if they plead guilty or found guilty or plead no contest, or if there's no contest plea involved, then it's a 10-day process. Bottom line, answer choice B is our answer. This type of options question where we have a stock position paired with an option is probably as advanced as it's going to get on the SIE exam. Now, for those of you taking the Series 7, this is standard. This is actually easier on the Series 7 when it comes to options. You get more advanced stuff than this. But for this exam, this is probably as hard as it's going to get. And again, if you need help with these, check out my options course. But here's what I would do in a question like this. First thing, I would, on your scratch, let's say laminated sheet with your pen, I would write out the what we have here just to kind of stack rank it so it looks kind of clean. We're long 100 shares at 50 and we're short at 55, call at 3. Now that short call is the obligation to sell stock at the strike price, 55. Call options get exercised if the market price is above the strike price. So only if the market price goes above 55 will the investor be forced to sell the stock that they already bought at 50. They'd be forced to sell that stock at 55. And if you think about it, that really wouldn't be that bad of a situation. Buying stock at 50, being forced to sell it at 55, plus you keep a $3 premium on top of that. That actually gets us to the maximum gain. The investor can make a $5 per share gain on the stock and then that $3 premium on top of it. One of the things I talk about in my options course is how you approach a multi-part option question. Whenever you have a stock with an option, you always want to look at things through the lens of the stock first. The stock is the most important part of the strategy. Now, if I'm long stock, I want the market price to go up. And what we just thought through there is what happens if the market price goes up. If it goes up above 55, the call gets exercised and we bought stock at 50, sold at 55, plus we kept a $3 premium. That is why the maximum gain would be $800. Now, obviously, that gets us to the right answer. There's only one answer with a max gain of $800. So B is going to be a right answer. But let's talk about the maximum loss. I want you to use the same process that I just talked about before. Look at the stock first. If we're thinking maximum loss, where would the stock lose the most money? Well, if the market price went all the way down to 0, the investor would lose their entire value of their stock position, lose all $5,000 of that position. But the call option, what happens there? Well, call up. If the market price is not above 55, that call just expires. the investor does still keep the premium regardless of whatever happens with the option bill. So yeah, if the market price goes down to zero, they lose all $5,000 of their stock position, but they do keep that $300 premium, which is why the maximum loss is $4,700. When we're in the cooling off period, there are a set of things that you explicitly can and explicitly can't do. And this question is specifically asking, like, hey, what can you do during the cooling off period? So let's go over those. There's three primary things that can be done. Number one, you can accept what we call indications of interest. So if any of your clients are like, hey, I might be interested in buying that thing, you can accept indications of interest. That's totally fine. Two, you can publish what we call a tombstone. Now, a tombstone is just it's technically a form of advertising, but it's the only legal form of advertising during the cooling off period. It's basically looks exactly like a tombstone. This used to go in like in newspapers back when newspapers were huge. Looks like a tombstone. It just announced, hey, by the way, ABC company's offering a bunch of stock to the public. Here are the underwriters that are doing this. If you have, if you're interested, call this number, blah, blah, blah. Now, neither one of those are answers up here, but the third thing you can do is you can distribute what we call the preliminary prospectus. Sometimes we call that the red herring to potential investors. When an issuer files a registration statement, that registration statement, the information that's in that registration statement will eventually become what we call the prospectus. Now, the SEC has a 20-day period where they look over that registration form to make sure that everything they've asked to be disclosed has been disclosed. They're looking for completeness, basically. Um, Now, the reason why we call the preliminary prospectus the red herring is because if you look at these preliminary prospectuses, usually there's a red box somewhere at the beginning that says, hey, by the way, this prospectus is under review. This is subject to change. This is not the final version of this thing. That gives us the answer choice C. That is something that we can do during the cooling off period. What can't you do? You can't take orders. Okay. Cannot be like, oh, I'll sell it to you. Can't take any kind of orders or sell it in any way. Sales literature kind of connotates that you're advertising it to some degree. And as a reminder, the only version of advertising that you can do is your tombstone. You can give out the red herring, which is it's not advertising; it's a disclosure document. Hey, if you're thinking about this, here's what you're getting yourself into. And also, D is kind of related to A. You can't sell it in any way. Can't take a deposit or take money for it. Or maybe the one last thing I would mention here is you can't recommend it either. Yeah, representatives cannot recommend this while it's in the cooling off period. Bottom line, C is our answer. This question references the three parts to the margin agreement, but we're really only asking about one of them here, and that would be the hypothecation agreement. That's how you say that word, hypothecation. Hypothecation just means that there is a pledging of something in return for money. I'll give you like a random example that's outside of securities. If I buy a car and I take out a loan to buy a car, I'm basically hypothecating my car to the bank that I borrowed that money from. If I don't pay it back, the car's yours. You can go sell it. Margin accounts work in a similar fashion where you're borrowing money from a broker dealer and you're saying, hey, if I can't pay you back, you can take my stocks are yours or my securities are yours. You can go sell them. So hypothecation relates to that. The customer hypothecates their securities to the broker dealer, saying, hey, I'm borrowing money from you. If I can't pay you back, you can sell my securities. What also happens alongside that is that the broker dealer, which typically doesn't have a bunch of cash on hand to lend out, will then rehypothecate those securities to a bank to obtain money to reloan to the customer. So any answer that's referring to like pledging securities in return for a loan is going to be our best answer. That's going to be answer choice A. A couple other quick things to point out here is answer choice B is the loan consent form, but obviously we're not talking about that. Answer choice C is really part of the margin agreement. The margin agreement goes over like the rules of the margin account. Actually, that was supposed to be an X. That is an X there. Part of opening a margin account, you have to be aware that if your account runs into trouble, if it starts losing value, if you have any money that's owed back to the broker dealer, they can start selling stuff in your account without notifying you. And then D is just nonsense. Can't do D ever. A lot of these rules, when it comes to cold calling or just calling up, prospects or clients, a lot of this comes from the Telephone Consumer Protection Act. The Telephone Consumer Protection Act basically says, hey, if you're cold calling people, you can generally only cold call them between 8 a.m. and 9 p.m. in their specific time zone. But there are exceptions to calling people outside of those timeframes. Number one, if a representative has a personal relationship with that customer, they can call them anytime. Call them at 3 a.m, who cares? But also, secondly, if the representative has been given approval from the customer to call them outside of those hours, cool. And in particular, they got written approval to do this. Even though it seems kind of like nonchalant, like he gave him a business card and said, hey, call me anytime. Hey, that is written approval. That is good enough. That's the approval we're looking for to basically call them outside of the 8 a.m. to 9 p.m. timeframe. So this call is permissible. It's not permissible because it happened within the allowed window. That's not answer choice A. It's permissible because we got written approval to do so. Answer choice D is our answer. The key to answering this correctly is being crystal clear on what each option gives you the right or obligation to do. And in my options course, I teach you that there are 3 pillars to mastering options. One of those is knowing what each option's right or obligation is. And let's just write that out real quick. So the long call is the right to buy. The long put is the right to sell. The short call is the obligation to sell. And then the short put is the obligation to buy. I'm not joking. Like, the way you master this is you know these off the top of your head without even thinking about it. Put them on flashcards. Like, if I were to bump into you at 11 p.m. at night, you're out with friends having fun. If I bump into you and I ask you what's a short put, if you're not able within 1 second to say obligation to buy, you got work to do. So know these off the top of your head. It'll help, especially with a question like this. Which of following equity positions exposes the investor to the risk of forced delivery? Now, one thing, you can use the words in the question to help you get to the right answer. Forced, when are we forced to do something here? It's only really when we have an obligation to do something. If the option involves a right, we're not going to be forced to do anything. So definitely not going to be A, definitely not going to be B. Those are rights. Now, forced delivery of underlying shares. I mean, if I'm delivering something, that means I'm giving you shares. What does that match up most with? That's going to match up most with answer choice C. You're delivering shares in return for cash. That is what a short call might force you to do. Answer choice C is the answer. This question tests your knowledge of secured versus unsecured debt securities, or we might call them like backed by collateral in some way, shape, or form if they're secured, or not backed by collateral if they're unsecured. I'm going to quickly jump to the answer here. There's 2 big corporate products that are unsecured. That would be commercial paper and debentures. Those are not backed by any kind of asset or thing that can be sold in order to pay off your bondholders in the event of default. But all the others up here are backed by some form of collateral. Equipment trust certificates are backed by literally equipment, usually like vehicles or construction equipment. Mortgage bond is backed by real estate owned by the corporation, and a collateral trust bond is either backed by a portfolio of securities that the issuer owns, usually securities from other issuers, or it could even be potentially a subsidiary. So like, hey, if our Procter and Gamble, if I can't pay you back, if I default in this, I'll sell Pampers, one of my subsidiaries, to pay it back. That'd be an example of collateral trust bond. But commercial paper, short-term, unsecured, 270 days or less to maturity, it's just full faith and credit. We'll pay it back, but we're not going to pledge anything as collateral. Answer choice C is the answer. Purchasing power risk, also known as inflation risk, is something that really hits and hammers fixed income securities. And if you think about it, I think you'll get the why. If I have an investment that's paying me the same amount of money on, let's say, a semi-annual basis, or whatever basis, doesn't matter, but I'm getting a fixed income, I'm getting the same amount of money, but everything around me is getting more and more expensive. That's something that investors generally don't like to hold in inflationary environments. In fact, the common stock market's a way better place to put your money if you're worried about inflation. So with that being said, what is going to get hit most by inflation, aka purchasing power risk? Number one, fixed income securities. Automatically, that's going to get rid of answer choice A and answer choice B. Neither of those are fixed income. And then we look at answer choices C and D. Both of those are longer term fixed income securities. In fact, that's something else to keep in mind when it comes to inflation risk. Longer term you go, the more inflation risk you worry about because you're locked into that fixed return for a longer period that's never good in an inflationary environment. Now, again, both C and D are both long term fixed income securities. So, which one's the better answer? C would be more susceptible. It's going to have the highest degree of inflation risk. Now, why isn't D? It's really only this convertible. Remember what I said up front about the stock market, in particular, common stocks are a good place to put your money in inflationary environments. Why? Well, if you look at the history of the stock market almost always outpaces the inflation rate, especially when you look over long periods of time. In fact, that's something that for those of you who are going to go take the Series 7 after this, if you have a question where it's like, hey, here's a suitability question, we have a customer worried about inflation, get them exposure to the stock market. That's almost always going to be the right answer. And because preferred stocks are convertible into something that does well with inflation, that's going to offset that inflationary risk a little bit. Therefore, answer choice C is our best answer. This is a greedy thing, totally illegal, totally prohibited, can't do this. If you get a big trade from your institutional client, hey, they want to buy 50,000 shares, that's going to increase a lot of demand in the market. More demand means higher prices. Well, hey, I'm going to be a little greedy for myself. I'm going to buy a little bit for myself on the side before my big institutional client buys their stock. No, you can't do this. This is what we call a front running or front running in general. Can never do this. Okay. Just to cover the other things up here, free riding. We've talked about that a couple times already. That's when an investor buys a security and doesn't pay for it. It's not technically illegal, but it can, get your accountant into some trouble. Churning is when a representative just trades like crazy in a client's account, usually to rack up commissions. And then marking the open is, flooding the market with a bunch of orders right at the opening price to manipulate prices in one way or another. Bottom line, answer choice B is our answer. This is a written complaint, or we should just say complaints. FINRA only defines a complaint as a complaint if it's in writing. Now, in writing would be literally like old school, like on a piece of paper, or it could also be an email, a text message, something like that. So we have a customer who's expressing some dissatisfaction with something. In fact, they're even alleging that they got some kind of an inaccurate yield explanation. I don't know exactly what that means. But anytime you get a complaint from a customer, your job is to forward it to your principal. Answer choice B is going to be your answer. You forward it to your principal and you work with your principal to try to resolve the issue as much as you can. The representative should not try to resolve it with them directly before they bring their supervisor in. You get that complaint, bring it to your supervisor, go from there. One other thing just to kind of reinforce is if your client calls you up or your customer calls you up and just screams at you, that's not technically a complaint, as weird as that sounds. But if they put it in writing, then get your principal involved and then try to resolve it with them as much as you can. But bottom line, answer choice B is the right answer. One of the reasons why we call mutual funds open-ended management companies is because they continuously are offering shares every day, or every day the market's open. You could have a fund that was established in 1940 that does basically an IPO every single, well, technically wouldn't be an IPO, it'd be like an additional public offering every single day the market's open. The way that mutual funds work is that when an investor submits a purchase order, like they want to buy shares of a mutual fund, the issuer creates shares out of thin air. So there are more shares outstanding when there's a purchase, and vice versa if there's a redemption or a sale. If an investor holds shares and they sell it back to the issuer, then they redeem their shares, as we would say, then those shares are destroyed, they're canceled, and they don't exist anymore. Anytime you see a question that involves, continuously issuing redeemable shares, that is going to be an open-end management company, AKA a mutual fund. Okay, answer choice B is going to be a right answer. The other big security out there that is redeemable, by the way, just so you're aware, what redeemable means is that that you're trading directly with the issuer. Okay. If I want to buy into a mutual fund, let's say a Vanguard fund, my money goes to Vanguard, they give me shares, and when I'm ready to sell, I sell the shares back to Vanguard and they cash me out. That's redeemable. Redeemable is kind of uncommon. There's only two securities in this exam, two primary securities that are redeemable. That would be open-end management companies and unit investment trusts, if you look at answer choice C. UITs are kind of like mutual funds, but they have a fixed portfolio. But the reason why they're not the answer up here is really, it's one word: continuously. UITs typically do a one-time offering of units. Hey, give us your money. We're going to take your money. We're going to invest it into a bunch of stuff. We're not, once we invest that money, it's not going to change. And then usually sometime later, let's say 2, 3, 5 years later, the UIT will come to an end. If securities have to be sold, securities will be sold if necessary to liquidate and put everything in cash, and then the investors are cashed out. But really, the only reason why C is not the answer is because it's not a continuous offering. It's a one-time offering with UITs. Bottom line, B is your answer. Who keeps track of who owns the security and is responsible for making payments to investors that are required? If it's like a stock, they also distribute proxies or voting materials. That organization is going to be your transfer agent. That's going to be our answer here. One of the biggest roles is keeping track of who owns what. And also, that's why we have a regular way settlement. If I buy a stock or even a new issue bond or whatever today, if I buy a security, it's going to take some time for the transfer agent to be notified of that and to add me to the shareholder list if it's a stock, or the bondholder list if it's a bond. But that's what the transfer agent does. The underwriter, we talked about that earlier. This is a financial organization that helps issuers sell securities in the primary market, but they don't keep track of who owns what. So not going to be B. A custodian is a financial institution that holds securities for customers. Usually that's either a broker-dealer or a bank. They don't keep track of who owns what security on behalf of the issuer, so it's not going to be C. Clearing, clearing agencies are organizations behind the scenes that make sure that trades happen as they should. So if there's a trade of stock, they make sure that the buyer delivers the cash, the seller delivers the stock. They're responsible for making sure the trades happen. But again, they don't keep records of ownership and names of bondholders on behalf of an issuer. Bottom line, answer choice A is your answer. We have another Regulation T settlement question. If you recall from earlier, we talked about if a purchase happens, the investor has either T plus 3 or S plus 2. We're basically saying the same thing. The trade date plus 3 business days, which if the trade date is Monday, June 1st, 3 business days after that would be Thursday, June 4th. That's going to be our answer. You could also do S plus 2, regular way settlement plus 2 business days. This stock would settle regular way Tuesday, June 2nd, but then they'd have an extra 2 business days on top of that to pay for the trade. That gets us to June 4th. Bottom line, C is our answer. This is a question that I bet some of you are getting wrong based upon the way that you are taught this information. A lot of programs out there will teach that a statutory disqualification is any felony conviction on anything or any securities related misdemeanor conviction. Now, we look up here, it's a conviction, but are there securities involved? No. But if you look at the set of statutory disqualifications in relation to misdemeanors, it's basically, yeah, it is anything involving a security, but also involves any time that you were dishonest. For example, if you perjure yourself in court, or if you steal something, even if it has nothing to do with securities. So a misdemeanor conviction for shoplifting or theft is a statutory disqualification. Answer choice A is going to be our best answer. Now, a couple of things to call out. You could hopefully figure out it wasn't B, because statutory disqualifications for criminal actions, it's a 10-year period that we care about. I bet some of you guys went with C, but again, remember that theft in general, doesn't matter if a security is involved or not, is a statutory disqualification. And then D is just nonsense. We do care about some misdemeanors. The misdemeanors you want to keep an eye out for that we don't care about would be like the big one's drug misdemeanors. So if you have a misdemeanor drug conviction, who cares? It's not going to impact your employment status, or it's not going to involve a statutory disqualification. Answer choice A is our answer. Interest rates go up, bond price goes down. This one's really simple. This is interest rate risk. That is exactly what the risk is. Now, to cover the other ones, credit risk is anything that happens that might result in the organization's default risk rising. Like if we realize a company is borrowing a lot of money, that might put their credit at risk and they might be more subject to default risk. That's credit risk. So answer choice A is not what we're talking about here. Liquidity risk is anytime you have trouble selling something, meaning you either can't sell something or you have to drop the price significantly just to sell it. There's no indication here this bond is tough to sell, so B is not going to be the answer. Reinvestment risk is also not the answer, but the reason why it's not the answer is it's the opposite of what we're talking about here. Reinvestment risk occurs when interest rates fall. And I'm getting money off of investment A with a higher interest rate. Interest rates go down, and maybe if I don't need that income, I'm putting it back into the market into a new thing with a lower rate of return. That's reinvestment risk. Bottom line, answer choice C is our answer. Like we talked about in a previous question with stock dividends, stock splits are the same general vibe where numbers are moving, but really nothing's changing because of the split or the stock dividend. Now, this is a reverse stock split. A reverse stock split results in fewer shares outstanding, but a higher price per share. Companies typically do reverse stock splits when they feel like their stock price is too low, but we're just technically legally manipulating our market price here. Just again, because we think our stock price should be higher. This is the only legal way that you can force your stock price higher through a reverse split. The best way to approach a question like this is math. You got to use some math for this. I'm going to give you what I call the stock split factor. I've got a few videos on my channel that go through this more in depth, but the stock split factor, if you look at the stock split, this is a 1 for 4. Just do the first number divided by the second number. That'll give you your factor. Our factor here is, we'll say 0.25. Okay. Once we have that, we're going to take that factor, multiply it times the number of shares that we start with, and then divide the price per share by that same factor. And this will get us to the new position. Another thing I'd recommend you do is make sure you figure out what the overall value of the position is up front. In this case here, it's 12,000. Why? Because we're eventually going to end with $12,000 of stock. That's a way you can double check your math. In fact, I haven't done the number crunching on the answers yet. That might even get you to the answer. It's like if we multiply, for example, looking at the first one, 100 at 120, that's $12,000 of stock. Okay, that could be the answer. But if I look at answer choice B, I haven't even done the math yet, other than just doing 100 times 750. Is that just $750 of stock? No way is B going to be the answer. Now, I'd have to pull out the calculator for C and D just to see what's happening there, but let's do the math. We already know what the math is here. 400 shares times 0.25, we're going to end up with 100 shares. That automatically gives away the answer. We know it's not B, it has to be A. And then if you divide 30 by 0.25, you'll get 120. And if you do the math there, we still end up with $12,000 of stock. Now, whether you have a reverse or a forward stock split, it doesn't matter. You can do the same math either way. You do, to find your factor, divide the first number by the second number, take that factor that, in this case here, 0.25, multiply times the number of shares divided by the price per share. That'll work every single time. Bottom line, answer choice A is our best answer. A trusted contact person is a great thing for a customer to have on record. This is someone that the firm can call in an event that they think that something weird is going on with their customer. This is especially important when we have what we call a specified adult. Now, specified adult is anyone who is age 65 or older, or anyone who is 18 or older that can't protect their own finances. Those are what we call specified adults. Now, firms are required to ask about a trusted contact person. Hey, if there's something weird going on with you or your account, and we can't, for whatever reason, talk to you about it. This is really helpful, especially if you have a client that's experiencing something like dementia. Do you have a person that we can call? Do you have someone that you trust that we can call and talk about the situation with? Now, firms have to ask for a trusted contact person but customers never have to give a trusted contact person. I mean, just to be frank, what if we have a customer who literally has no one they trust? That's possible. And in that circumstance, you're going to make them name someone? Nah. So firm must attempt to collect the trusted contact person, but the customer's not obligated to give it. Answer choice B is our answer. Rule 144 covers two different types of stock. Number one, there's control stock. Control stock is any stock held by what we consider an affiliate. And this question obviously says that this is affiliate held stock. By definition, an affiliate is any officer, director, or any shareholder that owns 10% or more of the outstanding stock. This person is an affiliate just by virtue of them being a corporate executive. They're probably an officer or a director. Now, when you hold control stock, you are subject to volume limitations. Volume limitations basically prevent you from selling all your stock in one big swoop, especially if you have a big position. And a kind of a cute way to remember Rule 144 is, the volume restrictions say that you can sell the greater of 1% of the outstanding shares, one, or the 4-week trading average, four, and you can do that 4 times a year, basically every 90 days. That's 144. Maybe that'll be helpful for the exam. But this investor, this corporate executive, is going to be subject to those control rules. They have volume limitations they have to worry about. But the other part of Rule 144 covers what we call restricted stock, and that is stock that is not registered with the SEC. This stock is clearly, let's point it out, clearly registered, so we don't have to worry about that. Now, if it was not registered, then they'd be subject to a 6-month holding period before they sold the stock, but that is not going to be the case. Definitely not going to be answer choice A because it is registered. Answer choice B is going to be your answer here. Anytime we have a control person, they have to file, whenever their position changes. There's Form 4 that notifies the public, like, hey, my ownership in this stock has changed. If they're selling if they're selling control stock, at least in this example here, they would also file Form 144 as well. So subject to volume limitations and filing requirements. Answer choice D is just nonsense. Answer choice C is also, we'll say, nonsense here. This is one of the more frustrating concepts or set of concepts to know for the SIE. Why? Because when it comes to the leading, lagging, and coincidental economic indicators, we're probably talking 20 data points, 20 things to be mindful of that fall into the different categories. Leading is an indicator that tells us, where the economy's headed. Lagging is telling us where the economy was. Coincident is telling us where we are right now. And I don't have an easy way to kind of cut it up for you. Just either know that stuff or you don't. But there are some ways you can maybe reason your way to the answer. I'm going to cut to the chase here. Just go to C. C is our correct answer here. Anytime we have a new thing, like new orders of something, building, new permits for building construction, or initial claims of unemployment, whenever we have something new, that's usually an indication of where the economy's headed. So answer choice C is going to be our only leading indicator up here. A and B are both lagging indicators. Now I'm going to point out unemployment because unemployment is so frustrating for this concept here. Unemployment can fit into all three buckets depending on what type of unemployment we're talking about. Initial claims of unemployment is leading. So if we have a bunch of people just done first time filing for unemployment, that's telling us, hey, they just lost their job. That's giving us an indication that person's probably going to be spending less money in the future. That might have an impact on the economy. So initial claims are leading. The current unemployment rate is coincidental. And then average duration of unemployment is lagging. If you think about it, like, to know what duration, someone has to become unemployed and then become employed again, or to fall out of the workforce. So like, we're kind of retrospectively looking back on that. That's why that's lagging. GDP, which is a measure of how well our economy's doing, that is coincidental. I know this is a tough topic. It's just, there's some ways you can try to get to the right answer, but bottom line, C is our only leading one up here. The only other leading one I would keep mindful of, because they talk about it a lot, is the S&P 500. The stock market oftentimes is, whatever's happening today in the market will give us an indicator of where the economy's heading in the next, let's say, 3 to 6 months. One thing I've noticed on my exam here is that I have a lot of option questions. I think this is either our 5th or 6th one. Just so you're aware, I'd expect you to see somewhere between 2 to maybe 6 questions on options. No promises. Who knows what you're going to see? But most people that report their experiences online usually say options are not a huge deal on the SIE exam. Now, for those of you taking the 7, buckle in because you're probably going to get a ton of questions on your Series 7 on options. Just I don't want you to freak out and think, oh my God, this exam has way more option questions than I'm used to. This is an option heavy SIE exam, but still, I hope that you feel comfortable enough to get to the right answers here because these are, even if they feel complicated to you, these are relatively basic foundational options questions. Not saying they're easy, they're just foundational. Now, this is an index call option, and index options work a little bit differently than your standard equity option. If we have an equity, AKA stock option, if there's an exercise, there is stock that is either being bought or sold, depending on what side of the transaction we're talking about. But shares or stock are being traded for sure. But when we have a non-equity option, that would include index options, VIX options, interest rate or yield-based options, and then currency options. But by the way, the last 3 I just mentioned there, you may not have even read about those because those are generally not brought up ever on the SIE, but maybe on the Series 7. When you have a non-equity option, when there's an exercise of that option, it is the responsibility of the writer, the short side, to deliver the in the money or the intrinsic value amount in cash to the holder or the long side. Basically, what's happening here is that that there's a delivery of cash from the short side to the long side. If I look down at the answers, there's only 2 answers that involve delivery of cash. Now, answer choice D is just nonsense. Answer choice C refers to intrinsic value, the difference between the strike price and the index's closing value, typically on the expiration date of the option, is how much the writer has to deliver. Everything call up, however high up above the index is, above the strike price, is the intrinsic value. You figure out whatever that number is, multiply times 100 times however many contracts are involved. That would be what the writer delivers to the holder. Bottom line, answer choice C is our answer. We've already talked about both of these in some way, shape, or form. Both REITs, we actually talked a good bit about REITs earlier. I talked about DPPs, like limited partnership investments, also, even though I don't think we've had a question specifically on them yet. But one of the things that you need to know about DPPs, there's really not much for the SIE you need to know about them, other than the fact that DPPs, like limited partnerships, have the ability of not only passing through gains from the business, but also losses from the business to their investors. Now, REITs, as we talked about, cannot do that. REITs can only pass through gains. Automatically, that gets us to answer choice A. Answer choice A is wrong. Not true. DPPs can do that, but REITs cannot. Okay. Now, if I look at answer choice B, REITs can pass through net income, but cannot pass through losses, whereas DPPs pass through both. That matches perfectly with what we just said there. Let's look at C and D real quick too. DPPs are just a form of business structure. They're not open-end management companies, so that is wrong. And also, REITs are not closed-end funds. REITs are just REITs. As we talked about this earlier, REITs are not considered investment companies, and therefore they're not regulated by the Investment Company Act of 1940. That is not going to be the answer. And then for answer choice D, Regulation D is a rule that covers private offerings, or what we call private placements. Private offerings of securities, typically to accredited investors, maybe a few non-accredited investors can be involved in there. Now, REITs and or DPPs, especially DPPs, can and oftentimes do involve private placements, Regulation D. But is that required? No. If, for example, like a REIT is publicly offered and that security is registered with the SEC, you don't need to do a Regulation D offering. And in fact, like Regulation D and national exchanges just do not match together. You do a Regulation D private placement to offer securities privately to investors. And when it's privately held, those securities are generally not eligible for exchange trading. And maybe if later the securities get registered by the issuer, then they could be traded on exchanges. But bottom line, D is just nonsense. The only answer here that makes any sense is answer choice B. This is a tough question that really makes you know the rules related to, we'll call it like anti money laundering measures. First, The currency transaction report is a government report that is made anytime someone is transacting more than $10,000 of actual currency, like cash. Now, if we look at the numbers here, we don't break $10,000. So if we're not above $10,000, a currency transaction report is not created. Now that relates directly to the suspicious activity report, which is going to be the answer here. So let's go ahead and get rid of A and C. We're not above 10,000, so those aren't involved. If you're money laundering, you might most likely know that a government report is created if you are transacting more than $10,000 of currency. So what's one way around that government report is what we call structuring, which is let's go right below that $10,000 threshold. Oftentimes we're just trying to avoid government reporting. If we see something like this, it doesn't necessarily mean something illegal is happening, but it certainly is a red flag. And whenever there is a potential red flag, it is a responsibility of the firm to file a suspicious activity report, specifically with what we call FinCEN, the Financial Crimes Enforcement Network, which is a part of the US government. There's no way to reason your way to the answer. In fact, if you start reasoning, you might think, okay, suspicious activity, probably want to tell the government sooner than later. Suspicious activity reports are 30 days. Okay. Or 30 days. If a currency transaction reports are 15 days. So if this was more than $10,000 and then a CTR will be filed within 15 days. SARs are 30 days. Bottom line, answer choice D is our correct answer. This is our second Federal Reserve question. The Federal Reserve is responsible for monetary policy. Monetary policy basically controls how much money's in the system at any given point in time. Now, all four of these answers relate to the four tools that the Federal Reserve has. These are all within their toolkit. But if they ever ask you which one is most frequently used, there's one quick answer to that. Open market operations. That's when they trade typically treasury securities with banks to either expand. They would be buying treasury securities from banks to expand or loosen the money supply. They would sell treasury securities to banking institutions to tighten or shrink the money supply. But bottom line, the most frequently used tool is answer choice B. There are two different types of risks that we care about, or we should say categories of risk on this exam. There are systematic risks and non-systematic risks. A systematic risk is any risk that applies generally to the broad market. And people categorize or talk about these risks a little bit differently depending on who you are, but I consider systematic risk as a category of risk. And under there, we find market risk, interest rate risk, inflation risk, and also technically reinvestment risk. But virtually all the other risks we talk about are non-systematic, meaning as an example, business risk. Business risk is the risk that I invest into a company that is struggling because of mismanagement or competition or something along those lines, and its stock price is falling because of that. Now, the question I'd ask myself is that a risk that's applicable to the entire broad market, or is that a specific risk to a specific organization or maybe a small portion of the market? That's more non-systematic. Okay. So systematic risk is broad, covers the entire market. Let's go through the answers and figure out which one's true. Answer choice A, wrong. One of the things you have to know is that diversification will help you with one big category of risk, and that's non-systematic risk, risks that apply typically to one security or one organization at a time. If I'm invested in a stock of a company that's struggling, if it's one of 500 different stocks in my portfolio, I'm not going to care too much about it. That risk is generally diversified away. But if I'm talking about a risk that applies to the broad market, like the entire market's coming down because of some economic event, does diversification help me? No. Well-diversified portfolios still plummet in value when there's a broad systematic risk that's applying. So answer choice A is just wrong. Answer choice B, remember, systematic risk is broad across the market, not just like one investment or one specific company. But if I look at answer choice C, it does affect the overall market. When we see the word hedged, I want you to think hedge means protect yourself against it. You can use index options to protect yourself against market risk or systematic risk. In particular, if you went, for example, long S&P 500 puts or long an index put, these are options that make you more money the further the general market falls down. So you can't diversify out of systematic risk, but you can certainly use things like index options to protect yourself against it. And then, D is just straight up wrong. It applies to more than just high yield debt securities or speculative equity securities. Systematic risk applies to virtually all securities in the market. This is one of those questions where if you're reasoning your way to the answer and like using terminology at your disposal, you might look at this, official close to the market, just prior to the official market close, and we're flooding the market with a bunch of trades to manipulate the market. You might look down at B and be like, oh, that almost sounds too good to be true. Is that really the answer? It is the answer. This is marking the close. Marking the open or marking the close is doing weird stuff either at the right at the open or right at the close to manipulate market prices. There's a bunch of different versions of this, but for sure, this is B. We already talked about a few of the other answers up here as well. Backing away is something we haven't talked about yet, but backing away is if I give a firm quote to a customer, the customer calls up and says, hey, I want to buy ABC stock. What's your quote on it? I say, oh, I'll give you a firm quote at $50 a share. If I JKLOL them, if I say, hey, just kidding, LOL, that's not actually a real quote, that is what we call backing away. You cannot do that. That's a FINRA violation, so it's not going to be answer choice A. We already talked about C. Interpositioning is introducing an unnecessary middleman, typically to charge your customer more. Can't do that. And then we also talked about D. Free riding is buying a security and then not paying for it by regulation T. Settlement. The key to answering this question right is understanding what an SRO is. Self-regulatory organizations are non-governmental organizations that have been given power by the industry to regulate the industry. There are a few examples of this that we care about on this test. The two big ones, and this is going to give away the answer, would be FINRA and the MSRB. Another one that you might see is the New York Stock Exchange also is an SRO and regulates the industry in some way, shape, or form. But these are all non-governmental organizations given power to regulate the industry from the industry. Believe it or not, FINRA is the only reason why FINRA exists is because the industry is like, yeah, we want to regulate ourselves. We want to make sure that we have some kind of regulatory body in place that make sure that things are happening as they should, customers aren't being taken advantage of, et cetera. If we had rampant fraud and bad stuff happening in the securities industry, fewer people would engage in the industry. So it's important to make sure things are, on the straight and narrow. Answer choice B is going to be your answer. The SEC is a government organization. If it's actually the government, it's not an SRO. So not going to be A. C is the government, not going to be C. SIPC is a nonprofit that basically offers insurance in case of broker-dealer failure, not an SRO either. Answer choice B is our answer. If you know your mortgage agencies, this one hopefully is a pretty easy one. There's only one mortgage agency. I always remember it as like grandma, GNMA. I don't know, for whatever reason that spells grandma to me. Grandma's safe. Grandma is safe because it has government backing. I don't know if that helps at all. But Ginnie Mae securities are directly, AKA explicitly backed by the US government. The other two agencies being Fannie Mae, and whether or not you knew this, C is Freddie Mac. Those have implicit or indirect backing from the US government. Still backing that's important and is helpful. In fact, the US government has a track record of backing these organizations when they experience financial trouble, but still, it's not explicit guarantee. It's not direct backing. Answer choice D is just nonsense because private label mortgage-backed securities have no backing whatsoever from the US government. Again, answer choice A is our answer. A combination offering is an offering of securities where we're selling a bunch of stock to investors. It feels, it's very much kind of like grounded in the primary market. Like, let's say an initial public offering of a stock is happening. This is actually something that I experienced directly when I worked in the industry with Facebook's IPO, which happened back in 2012. When Facebook went through its initial public offering, a good portion of that public offering was stock being sold directly from the company that was going into the company's business accounts. But also another portion of that was shareholders of Facebook stock that were just like, yeah, I want to cash in. A lot of those were executives of Facebook. Some of those were people that, that were initial, funders of Facebook up front. But a combination or a split funding offering is one where we have, a good portion of the proceeds actually going to the issuer like a normal primary market offering, but also another set of the proceeds, another set of stocks being sold by shareholders other than, not the issuer, and it's going into their pockets directly. Therefore, answer choice A is our best answer. First thing, all of these can be considered money markets. There are some exceptions, but all of these are generally money markets. Now, what is a money market or a money market instrument? Any debt security that is issued and has 1 year or less until it matures or, or when it's redeemed. All of these fit that bill. Now, which one finances international trade? There's a really quick answer there. That's a banker's acceptance. Without going into too much detail, if we have an importer and an exporter doing business, sometimes it's important to have a bank in the middle to make sure that the importer delivers the cash, the exporter delivers the goods that they're delivering. And so they create a financial instrument that kind of helps facilitate that process. That's what we call banker's acceptance. And sure enough, if you ever see anything about financing international trade, it's almost always going to be a banker's acceptance. What is true of mutual funds versus not so true about closed-end funds? That's basically the question here. I'm going to go through the answers and just talk through each one here. Answer choice A. Now, what's true of open-end funds? A is not true of open-end funds. Open-end, aka mutual funds, have that continuous offering, right? Whenever investors buy shares, they create shares. Whenever investors redeem shares, they cancel those shares. So it's not a fixed one-time offering of those. Now, closed-end funds have a fixed one-time offering. A is true of closed-end funds, but that's not what the question's asking. So not going to be A. Also not going to be B. Weirdly enough, open-end funds, if there's a ton of demand for a mutual fund, that's not going to drive the price of that mutual fund up. And it's because of that continuous offering. If we have a ton of people that show up and like, hey, I want to buy shares of the ABC mutual fund today, remember, the fund is just creating more and more and more shares, the more demand they get. And whenever you have that ability of creating more of the product, whenever there's more demand, generally the price is not going to increase because of that. Weirdly enough, the NAV of a mutual fund is not generally impacted by supply or demand. But with closed-end funds, closed-end fund does an initial public offering. Those shares then trade in the public, and there's a fixed number of shares outstanding. There's a closed-ended number of shares out there in the market. If there's a lot of demand for something where there's a limited quantity of them, price that thing will go up. So B is true of closed-end funds, but not of open-end. Answer choice C is also not correct. And I'd say a little bit more of an advanced topic, something you'd probably see more tested on the Series 7. But the question is, what security can a open-end or a closed-end fund issue against the portfolio? Open-end funds can only issue common stock against the portfolio, or another way of saying, if I'm buying shares of a mutual fund, I'm technically buying common stock in that fund itself. Open-end funds can issue preferred stock or debt securities against the portfolio, but closed-end funds can. Closed-end funds can issue common, preferred, and debt securities against the portfolio. Now, we're not talking about what is held in the portfolio. That's a whole different conversation. We're talking about what does the management company issue against this portfolio of securities. I wouldn't be too concerned about that. If you understand answer choice D is our last answer, got to be the right answer. You have to know this about open-end funds. Within open-end funds are, constantly, there's a constant offering of them. When investors purchase them, their shares created. When they redeem them, shares are canceled or destroyed. And the base value of those transactions is the net asset value. The NAV is what you always trade at, or at least it's a foundational price for all mutual fund transactions. There is an NAV on a closed-end fund, but NAVs on closed-end funds are just indications of what the fund is worth on a per-share basis. And it doesn't necessarily relate, or it doesn't correlate with, probably does correlate, but it's not directly related to the price that an investor would buy or sell the security for. Think of NAV on a closed-end fund as, hey, these shares are worth this. Let's say they were $20, but could the market push the price of that upward above 20? Yes. Could there be more supply, more people selling, and the price is below 20? Yeah. The NAV is just an indication of what the shares are worth, but the shares will trade at the prevailing market price in the market. So answer choice D is true for open-end funds, but not true for closed-end funds. That is our correct answer. Credit risk is any risk that results in the security having more default capability, or we'll say default risk. For example, if I'm invested in a bond and the issuer is up to their neck in debt, like maybe they have to pay more and more interest on debt that they borrowed, then I worry a little bit more about credit risk. And if that credit risk gets bigger and bigger and bigger, that security might eventually default. That would be default risk. Now we're looking at a municipal revenue bond. A revenue bond from a municipality is a bond that's issued to fund some type of revenue producing project. That could be something like an airport, it could be a toll road, it could be a convention center. Let's go with something kind of fun and let's say like a zoo. Municipality borrows money from investors, builds a zoo, and then we use ticket sales from the zoo to pay off that borrowed money. That'd be a good example of a revenue bond. So what's going to put a revenue bond at risk of being paid off or, risk of default would be anything that poses a risk to the revenue that that project is receiving. Let's just go through the answers here. Answer choice A, rise in prevailing interest rates. Well, this is a 5% municipal bond. Rising interest rates might impact how much they'd have to pay on interest if they borrowed more money, but it's not going to impact this bond in particular. In fact, this would be good. This would be like not good, but it'd be like, hey, thank goodness we borrowed money when the interest rates were 5%. Now they're at 8%. It'd be more expensive to build the zoo if we waited. So it's not going to be answer choice A, but answer choice B gets directly to what we were talking about before. A decline in user fees and revenues generated. Yeah, if people don't show up to our zoo, that revenue bond is gonna fail. So B's are going to be our best answer. Let's just go through C and D just to make sure. A decrease in local property tax collections. If this was a general obligation bond, that would be something that we would be worried about. General obligation bonds are paid off with property taxes. Sometimes we call those ad valorem taxes, but not this type of bond. An increase in the national rate of inflation, that might create some issues. It's probably our second best answer because if inflation's rising, prices are rising, that might mean fewer people are going to the zoo. I don't know, but that's a stretch a little bit. Bottom line, what's going to put us at most credit risk here is people just don't show up and use our revenue producing project in some way, shape, or form. We have fewer users. Answer choice B is our answer. We talked in an earlier question about unit investment trusts. No, the question wasn't specifically on UITs, but this question is, what's a unit investment trust? First, it is a redeemable security, meaning that you buy and sell it directly with the issuer. There's no trading of this generally in the secondary market. But another thing that makes a UIT unique is it's a fixed portfolio. If you imagine this is basically like a mutual fund, but once they give you give your money to these organizations that create UITs, there's a one-time offering. So that's something that makes it a little bit different than a mutual fund, but one-time offering, your money goes into the portfolio. Your money is then invested into a fixed portfolio. So if like the advisor that puts that thing together picks out 30 different stocks, the stocks they pick out for you are set it and forget it. Those never change. UITs always have a termination date or a maturity date. At the end of the UIT, at that termination date, all the securities in the portfolio are sold and then the investors are cashed out. That's what a UIT is. So the answer that's going to match up best with that, answer choice B. We've seen risks come up a number of times in this exam, and risks are something that you're going to see brought up at least a few times on your SIE exam. So be ready for them. Which risk is least applicable to a 30-year zero coupon bond? Let's just jump to the answer. The answer is going to be A. Now, reinvestment risk is the risk that you're making money off of investment A, interest rates fall, and now the money you're getting off of investment A, if you don't need that money to live on, then you put it into investment B. But because interest rates have declined, now you're getting a lower rate of return on that new investment. A zero coupon bond doesn't pay you any income. There's nothing to reinvest. Maybe devil's advocate, you could say, like, as we're approaching maturity, like at the maturity date when we get our entire principal paid to us, then you could argue you might have some reinvestment risk there. But if we're like 1 year into a 30-year zero coupon bond, we have absolutely zero reinvestment risk that we have to worry about. So answer choice A is going to be your best answer. Going through the rest of them, B and C are particularly big risks that we worry about when it comes to long-term zero coupon bonds. With purchasing power or inflation risk, we always look at fixed income securities that are long-term. Those are most susceptible to it. Interest rate risk, interest rates go up, bond prices go down. What is impacted the most? Long and low, long-term maturity, low coupon. This is basically as long as it gets and as low as it gets. So this is going to be heavily impacted by interest rate risk if interest rates go up. Whether or not there's credit risk, it just depends on the corporation. If this is a corporation that's having trouble financially, yeah, we got credit risk, but we don't know enough information to determine if credit risk is a thing that we care about here. But bottom line, we don't care at all about reinvestment risk. You made it. You made it to the last question. So let's attack this one together. We have a question on a short-term secured loan where a financial institution sells that securities with an agreement to buy them back later. Now, you could probably use the language that's in the question if you had no idea what you're talking about to get to answer choice C, and that is our answer. Or maybe you've been wrong on a number of these questions where you think you have the right answer, so you're kind of second guessing yourself. But this is for sure what we call a repo. Now, a repurchase agreement is just a weird loan. That's all it is. So, for example, like I'll make up something real basic. If I take these sunglasses, my daughter's sunglasses, and let's say I need to borrow $5 from you. If I sell you these sunglasses for $5, hey, here's the sunglasses. Take $5. You give me $5, you have the sunglasses. But also, we have an agreement that hey, in 1 week, I'm going to buy the sunglasses back from you for $6. I sell you the sunglasses. Take it. Here's your sunglasses. You give me $5. 1 week later, we have an agreement where I'm going to buy them back from you at $6. And the difference between I give you $6 back. You give me the sunglasses back. I got them back. Great. I borrowed $5 from you for a week. I paid you back $6. The difference of $1 is your interest. That's all a repurchase agreement is. The other things up here, treasury bills are unsecured. They are from the U.S. government. They are short-term money markets, but they're unsecured. And basically everything from the Treasury Department is unsecured. If these default, it's not like you get a piece of the White House or anything. Anticipation notes, depending on how they're set up, are typically unsecured, but they're municipal securities that are issued in anticipation of like future money you're getting off of like taxes or revenue or something. That's just not what we're talking about here. And then commercial paper is always unsecured, short term, 270 days or less to maturity. It's just a way for a corporation to borrow some short term money. But that gets us to the very end of this. I hope you did well. If you did well, congratulations. I'd say go sit for the exam, especially if your score is in the mid to high 70s or higher. You're probably ready to take this thing. If not, if you either scored right at 70 or something below 70, even significantly below 70, don't beat yourself up too much. You can always improve your score. So just keep grinding. If you need any help, like I said up front, you can always text me, 720-593-1865. We can talk about potential tutoring. I'm happy to offer as many free resources as I can to you. Just let me know how I can support you. As I said up front, I'd love you if you like the video, if you subscribe, because I will be releasing more and more of these videos every single week. I want to definitely get myself out there on the social medias. And if you have any feedback or if you have any questions about what you saw in this video, put it in the comments below. I promise I will answer. Appreciate you hanging on this long. Thanks for hanging on to the end. Until next time, I'll see you.